strikes in America.
It's got to be a top story, but it's a different strike. I was thunderstruck. Bramo nailed this yesterday. She said, pay attention to 10 p.m., and she was absolutely right. There, I was watching Twitter or whatever. Afterthought came in late, partying, and I'm up watching and the whole thing, and there it was. This is a hyper surgical strike. This is a strike I've never seen. This is a strike Joe Biden has never seen.
Elisa, it's 12,700 workers across 3 plants.
There are 3 ways to interpret this. Number one, this is digging in your heels for a prolonged strike where you can allow your $825 million strike fund to last. Number 2, this is just the beginning, although it's probably just pushing out the deadline and you're going to negotiate, or something in between. The difficult part for me is, what is the red line? What are they looking for? We've already seen quite a few concessions.
Tom, it is not the F-150. It is not the Silverado. It is not Ram pickups, but that's in the back pocket if they want to escalate this even further.
But are these the cool cars? I mean, it's the Bronco, the GM Colorado, the Stellantis Wrangler. I can't believe I'm saying that. Doesn't work. The Jeep Wrangler,
No.
That
folks.
doesn't work at all, does it?
It doesn't work. There was Stellantis Wrangler. And there's another issue here, which I mentioned in the last hour. Bring it up if you would. On radio, it's my childhood. It's a 1968, 1969 Ford Bronco. This was my ute. This is all we drove at home. I'm serious. And John, Joe Biden's auto company made a $2,100 Bronco. The one you would own now, the one only you could style in, or Bramo, $71,000.
Yeah, that's before you start adding stuff on.
No, that's a peak one. That's a peak one. It's like a 41,000, but you gross it up.
You can push
71,000.
You can push it up.
These are expensive cars.
Expensive.
Is this, Joe Biden wants this to be about America. Is it, or is it about building fancy cars for a narrow segment?
Tom, it's increasingly expensive to own one, that's for sure, at a time where inflation is still a problem in this country, and maybe in our future, a labour market that's a whole lot softer. The good news is this labour market is still strong. What's the message going to be from this White House later on today? Tom, later on this morning, when you come out and say you are the most pro-union president in the history of this country, do you have any choice? Do you have any choice whatsoever than just to back the UAW and go against Detroit's Big Three?
Go against is a key phrase. Or Bramo, what do you think? Is he going to go against his, you mentioned earlier, Mary Barra? Is he going to go against Mary Barra? Is he going to go against Dearborn that didn't go bankrupt? Is he going to go against the French? And how do you pronounce it? Peugeot?
Peugeot. There is one playbook for him to come out and say, I trust that both sides will negotiate in good faith.
Oh, there it is.
I am looking for, it's
there.
important for workers to have rights. It's also important to have a viable auto manufacturing sector. I'm keeping in close contact. And let cooler heads prevail. And that's what we're going to hear. And then he's going to get on the phone and be like, come on, figure it out, guys, please.
If that was the statement, fantastic. That's not the statement, the words that come from the most pro-union president in the history of this country. I don't think you get to put out that statement and then go on a campaign trail and say all those things.
Not mentioned in, the emotion.
But ultimately, he's a politician and can do whatever he wants, but I'm just saying it's hard to square that circle.
Is this about a 32-hour work week? Which is like completely un-American. It's like completely French.
Tom, I think it's about all of the above, a lot of the rights that were lost going into the financial crisis and coming out the other side.
Yes.
There's a feeling that over the last decade or so, a lot of these workers have been left behind.
Yes.
And this is a once-in-a-generation opportunity to take a first step. I think this is really important, a first step towards doing something about that. There's a greater feeling, Tom, that this ain't it. This isn't it, and once you're done with it, it's over. That this is the start of a process,
Our Craig Trudell was fabulous on it. He lived it in the heart of Michigan. I lived it on the edge with Rochester Delco. But the union effort in the automobiles of our childhood gave us the middle class. Honestly, I don't know if Coventry was that way in England, but here they handed America a prosperous middle class.
It's a limited strike so far, and the automobile companies in the pre-market, they're doing okay so far. Equity futures on the S&P positive here by 0.1%. Yields are just about unchanged, higher by 3 basis points at 432. And there's crude, Lisa, screaming $90.51.
It's a light day of data ahead this morning, 8:30 a.m. We get September Empire manufacturing data. It's been messy, but maybe a read on how things are playing out there, as well as 9:15 a.m. industrial production. 10 a.m. a read on how much those higher oil prices that you're mentioning, John, are affecting sentiment. University of Michigan Consumer Sentiment Survey. And at 10:05 a.m., do not miss this. Our own Maria Tadeo interviewing the France economy minister, Bruno Le Maire, after a discussion already with Nadia Calvino of Spain. There is a lot of dissent among the finance ministers of Europe who are meeting alongside Christine Lagarde about whether it was a good or a bad idea to hike yesterday.
25 basis points. Divided, a split on the governing council, and the euro weaker potentially for a 9th consecutive week against the dollar.
Did you get out of your ARM shares at 66?
I wish I had it done.
I saw that. I thought of you yesterday afternoon.
Quite a pop we got yesterday.
Yeah, it's pop,
we'll touch on that in about 25 minutes. Sarah Hunt with us now, Chief Market Strategist at Alpine Saxon Woods. Sarah, wonderful to see you. Let's start here. Give us one good reason to buy GM, Ford, and Stellantis with this going on.
I think that's a very difficult question. I mean, you'll see that the stocks are only a little bit lower in pre-market. It really is going to depend on how long this takes to work through. I think there's a lot of things that are on the table. I think job security is definitely part of it for the union. And I think the real question for those three is how you continue to be competitive globally when you've got these issues going on at home, and you've got issues with higher oil prices, right? Because those cars are more expensive not only to buy, but to fuel right now, too. So I think that there are a lot of problems right now in the auto sector, and I think for those three in particular, this is not a great time for them to be facing this sort of action.
The emotion here of a president today goes down to the manufacturing multiplier. Yours and my ute, where it was simple. A manufacturing job was better than being a TV anchor because it was more productive for America. Is there a manufacturing multiplier still in this nation?
Well, I think there's definitely a manufacturing multiplier, and I think that the targeted strikes are showing you exactly how, when you've changed the manufacturing to each plant does a different thing and gets it to the ultimate end assembly, that I can strike anywhere and I can have a big effect on a giant work in a small way. So there's definitely a problem there. And the question about manufacturing, we're trying to reshore manufacturing, right? So this is part of, I think, the big labor question of when I reshore manufacturing, what's going to happen to prices? And I think globally, we're setting ourselves up between energy situations and bringing production back home to have just higher prices across the board. So I think that there's a longer big tail here to some of these discussions that are not just about individual micro situations.
But AI is going to solve it all. It's going to create robots and all sorts of programs that can just make all of the things that we need. I mean, this is sort of the great hope to keep pricing down. Why wouldn't you just hedge your bets and go strong into energy, go strong into tech, and forget the rest of it?
Well, you know, we've been positive on energy, and that has not been the best thing to be all year, but I think it's finally starting to come around, and it's actually coming around almost too quickly because oil prices have risen so quickly that it's almost an issue. But I think that that's part of the problem for the general populace, is that if I am going to do this with robots, if AI is going to save me from a productivity standpoint, then how am I going to have job security? And I think that that's part of the tension that's going on right now, especially with the automakers.
Elaborate on that. Why do you say almost too quickly?
Because it does have demand destruction issues, right? When oil prices shoot up dramatically, you do start to see demand destruction. And part of the reason that oil prices have gone up is because the Saudis are taking oil off the market. And at a time when we've essentially depleted our SPR. So there isn't a lot of backstop in terms of excess excess production of oil. And especially with the U.S., as John pointed out earlier, at record highs for production. So I think that movement higher is not, the stocks haven't caught up to it because they don't really believe it, right? So from an investment standpoint, you're not getting the benefit of those high oil prices, but you are seeing them on a consumer problem, as a consumer problem.
35% move since June on crude has been quite a move. Sarah, do you see these multinationals, these big oil integrated companies leaning harder into fossil fuels? There's a big conversation about where BP is going in Europe, where Shell is going in Europe. What are the US players doing in energy?
I think every single one of them is trying to find a way to be both relevant in fossil fuels, but also to look towards a future where fossil fuels play a smaller part. The question really is the timing on that. And I've said before that I think that tail is a lot longer than people want it to be in terms of what countries are trying to legislate and also what people would like to see. But the truth of the matter is that you do need fossil fuels and you're going to need them for a longer period of time. And the earlier discussion about emerging markets, that they're not going to be able to transition to electric all that quickly. The infrastructure isn't even there. So as they grow bigger, their demand for oil, even if it's coming down in OECD countries, it's going to be going up in other places.
I got airlines flat on their back. Airlines have been a post-pandemic disaster in terms of shareholder return. I've got Exxon with a 3% dividend. Okay, generous, I guess. The 5-year dividend growth rate is totally unacceptable. Are they going to get use of cash religion? Are they going to become like Apple and start throwing cash back?
I wouldn't want to opine on Exxon specifically. I think some of the other oil stocks have definitely gotten religion on the dividend and return of capital to shareholders, because I think that was something that they've been told by Wall Street and by investors that they want. They don't want them to go out and spend all this money on production when oil prices are not as high as they were right now, but they would like to see some return of capital. So I think that there has been some change in the way that capital allocation is looked at across the industry.
Does it matter who's in the White House when it comes to the energy patch? We make a big deal about policy coming out of President Biden, former President Donald Trump. Crude's back in the 90s, but crude production in America is close to all-time highs, Sarah, and that's happening with this very anti-fossil fuel tone coming out of the White House. Does it even make a difference what they've got to say?
It makes a difference when it comes to permitting, and it makes a difference when it comes to production that you don't have yet, right? If you're looking at an area where we've been able to extract a lot more oil out of fields that were already there with the technology changes, and that's where your productivity comes in, then it matters less. When it comes to looking at new areas to be able to either explore or drill, then it starts to make a difference on the edges.
Sarah Hunt, thank you. It's good to see you here in New York. Sarah Hunt of Alpine Saxon Woods. Construction on energy for a lot of this year, and the market, Sarah, is starting to come your way in a quicker way over the last couple of months. If you are just tuning in, welcome to the program. Lots to talk about in this market, including this move in crude. We're in the 90s on WTI, highs of 2023, $90 and about 50 cents for Brent crude, $94 a barrel,
wow,
up by 1/3 of 1% in today's session. In the equity market, we're positive here by 0.13%. Barry Knapp's coming up a little bit later. That's in the next hour and about 50 minutes from now. Down in Washington, D.C., up next on this program, TK. AMH, our chief Washington correspondent, on the latest in Detroit and what we may or may not hear from this White House later on today.
And also what she will hear from Vice President Pence tonight with Joe Matthew, an important conversation, not only on politics, but of the UAW of Indiana and north to Detroit.
What do you want to hear from the VP, former VP, later on?
I would like to know how he's going to find the ability to support the other selected Republican candidates because he can't raise money. Bob Dole was a distinguished, earned World War II veteran. Yes, he did run for president, but Bob Dole never connected with the greater American populace, and that's where Pence is.
Lisa, that field is still big, and that spread between the former president and the rest is getting bigger, not smaller.
And if you take a look at who's gaining popularity, it's the candidate Ramaswamy, who is basically,
he's gone on to TikTok.
Yeah, and he's even more Trump than Trump, which is amazing,
Sarah,
right? Considering some of the controversy of TikTok.
What is this guy doing? Are you kidding me?
He's gone on to TikTok. Have you seen that?
Yeah, exactly. Well, that's the smartest thing I've heard on the guy.
Well, hold on
you think it's a smart move to go on to TikTok?
No.
Okay.
I think it's an embarrassment. We're running for president thing. You know.
Where's the surveillance cork? I mean, look, I will say this.
Yeah,
that,
exactly.
Thank you,
Lisa.
Anytime. I'm here to have your back. The whole idea that the only way to gain popularity is to out-Trump Trump. I mean, that seems to be the concept here.
Stop. I've walked by, I've never been in it. I've walked by the Situation Room. You look through the little glass and the Marines standing there ready to shoot you. Can you see that guy in the Situation Room at the White House?
Headline across the Bloomberg. The president to deliver remarks on UAW and the automakers' negotiations later on today. Just looking for a time, and hopefully I'll find one for you. Coming up very shortly, Bloomberg's Anne-Marie down in Washington, D.C. From New York, this is Bloomberg.
London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside? How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Wall Street is waking up. Europe is already trading. And starting Monday, Manus Cranny and Danny Berger will make sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. Take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, premiering Monday, only on Bloomberg.
Day one, we told these companies, we don't expect them to delay and drag things out, and that's what they chose to do. We didn't want to be here. We want a fair agreement. We want fair economic and social justice for our members. That's what this is all about. They've had a decade of record profits. When they're profitable, it's all theirs. But by God, when workers ask for their fair share, it's the end of the world.
The strike is on. President Sean Fain of the UAW joining the picket line in Michigan. The latest from the White House in a statement moments ago. President Biden will deliver remarks on the contract negotiations between the United Auto Workers and auto companies. Those auto companies in the pre-market, GM, Ford and Stellantis, are doing okay. It's a targeted strike, Tom, so far across 3 plants for a little more than 12,000 workers.
Let's get right to it right now. Too important of a conversation today. And one of the most important treatments was John Farrow's repetitive conversations with a guy missed this morning in this administration. And John, that is Martin Walsh, union representative, Boston, Massachusetts, former Secretary of Labor. Boy, is he missed this morning.
And doesn't have an official replacement as yet. Julie Sue not confirmed, Tom. There's a lot we need to hear from this administration this morning, and hopefully we get some answers on what their position actually is later on today.
Amory Horton joins us this morning. That is important. Amory, I'm just going to cut to the chase. What will the president say this morning? How is he being briefed by his cabinet and administration?
What you're going to expect from the president, I imagine, is what we heard from him a month ago in a statement when there was 1 month left on this contract. And what he called for was a just transition and that the auto companies make sure they are paying a good living wage for union workers to be able to support a family. So he's going to be walking this fine line of making sure he is still, of course, wanting to have this policy goal of electrifying the grid and support for the EV manufacturing, but at the same time, wanting to make sure he's seen as a president that's fighting for labor inside the government.
Has this strike grabbed the nation? I can't believe this morning he's going to vamp into a political ballet on EV and grid transmission, say in Oklahoma and Texas. In the old days, there'd be no other story except the strike and the potential violence of the strike. Is that not true this morning, Anne-Marie?
Well, you're absolutely right. I mean, what you're seeing from Sean Fain, this stand up and strike, is reminiscent of the sit down strike of the 1930s, which many would have said was the strike heard around the world, which totally took not just the United States, but the world by surprise and what was going on at manufacturing plants like GM. So what you see as Sean Fain do is really try to harken back to this time in the 1930s. He's trying to really revolutionize and revamp what the UAW is today. At the same time, we do see him trying to make sure he's protecting the strikers' fund by targeting these plants. But this is going to be top of the agenda for the president, not just for the fact that he continuously says he wants to be the most pro-labor union president in history, but also for the fact that this could mean a recession in Michigan. Michigan, Trump won. He was the first Republican to win since the 80s, and then it flipped to Biden. This is a key state for the Democrats in November of next year.
MH, can you give us a sense of how deep the pockets of UAW are? This is very targeted. It's 12,700 workers across 3 plants. Just to give us an idea of how far this could go, how big this might be.
Well, we spoke to Seth Harris last night, who used to be an aide to President Biden when it comes to labor. He's actually the individual that helped him coin the term that we continuously repeat from the president, that he wants to be the most pro-union president in history. And he said that he thinks this could last weeks, not days. Potentially, that's the kind of money the UAW has right now. But that is why, Jonathan, they're doing this targeted strike. They don't want to make sure they burn all their cash at once, and also want to make sure they could support their workers, because they're going to be paying out of the UAW strike fund to support these workers. So what he thinks is that this will last for weeks. That's going to be very challenging for the president in Washington, D.C., because this might end up being coupled with a government shutdown. The U.S. government runs out of funding September 30th, and Anna Wong of Bloomberg Economics says if you put together higher oil prices, strikes in Michigan, and the other states that have these plans, but really Michigan, alongside a shutdown in the U.S. government, that could mean the difference of a recession or not.
At the crosshairs of this debate, and what I'm hoping to hear from President Biden, is something about the electric vehicle policy that he has, because this is really at the crux of some of the concerns by the union. Just to give you a sense, most of the EV factories are not unionized, and typically electric vehicles and their parts require fewer workers, which means fewer unionized members and fewer jobs. How much can he back away from what he has put out there in terms of the move away from traditional automaking?
Well, you can't back away from it, right? There's money flowing out the doors from Washington from federal spending and grants and tax rebates if you move to the electric vehicle industry. Lisa, and it's not just the fact that an EV requires less individuals. The plants are also, for the most part, being opened up in the South, in right-to-work states where it is illegal to unionize. And the UAW wants to make sure they are part of that transition, which is why at the end of August, you saw from the Energy Department a press release about more money and more federal spending that will go to traditional auto plants that can retrofit for the EV future. This, to me, really seemed like an olive branch from the Biden administration to the UAW to make sure they know that they are not left behind. But as you say, this is the crux of the matter. There's traditional issues at play: pensions, work-life balance, higher wages, retirement. But there's also this tension of Biden's 2 competing policy goals. That is greener economy on the top of labor unions.
So why has the Republican Party been so quiet on this? Why can't they come out and taken a strong stance one way or another at a time where the Rust Belt and the unionized members are increasingly becoming swing voters?
Well, there's 2 things. One, not everyone is staying silent. Former President Donald Trump has been asking the UAW for weeks for their endorsement. This is a group that endorsed Biden. Sean Fain said they will not endorse former President Trump next year. But at the same time, at this moment, they've held off endorsing anyone. They are clearly irked by what they're seeing coming out of Washington in terms of policy goals. And Sean Fain has said so much in less polite words. So the former president has been trying to goad them to try to get their endorsement. But when you talk to pollsters, even if you see the top brass of labor unions side with the Democrats and the leadership, you need to look at the rank and file and where they're working. Look at the exit polls of 2016. How many individuals flipped from union households, from Obama to Trump, and did not vote for Hillary Clinton? These are key states. So you will probably start to hear more Republicans come out and speak about this, but they need to be careful as well, because it's those rank and file voters that they want.
AMH, you'll be speaking to one a little bit later, the former VP, Mike Pence, on Balance of Power, alongside Joe Matthew. What's the focus of that going to be?
Well, there's a lot to speak to the former VP about, but he has already weighed in on what's going on with UAW, and he comes from Indiana, where there are a ton of manufacturing plants that are tied to the auto industry. So he's going to have a on-the-ground sense of what this could mean. And what he had said about UAW says he was president of the United States, he would be sitting people down. This is not just one more contract dispute between auto workers and the big three in this country. And he said it's the failed policy of the Biden administration. So I think he will take a lighter tone than the former president, but he will be on Trump's side in the sense that they think this is an EV glut, and the auto workers should be siding with Republicans come November.
AMH, thank you. Looking forward to the conversation. Balance of power, the former vice president. Mike Pence sitting down with Bloomberg's Anne-Marie. Some comments from Mary Barra of GM to CNBC earlier on this morning. These are the headlines. They think the strike can be resolved very quickly. Didn't have to be here. They're evaluating production changes. We have talked to many members, Tom, of the White House. The latest from GM this morning.
That's the beginning of the communication. I'm sure we'll see it from Ford and Stellantis, Chrysler, as well, but the key communication is going to be the President of the United States.
And he will address the nation and UAW, the auto workers, and Detroit later on today from New York City. Good morning.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
What do you have for skincare for men in their 70s that have a lot of wrinkles? I mean, is there any way to get rid of the wrinkles?
I have a lot of amazing things, but maybe it'll be a little bit beyond skincare.
Heading towards a week of gains on the S&P 500. We're up on the week so far through Thursday on the S&P and on the Nasdaq too. Equity futures this morning on the S&P positive by 0.1%. On the Nasdaq 100 down by about 0.1%. In the bond market, yields higher off the back of an upside surprise on US retail sales and PPI, driven to some extent by what's happening in the commodity market. Yields up by 2 basis points on a 2-year, 5.0368%. Back in the 430s on a 10-year. Lisa, back in the 440s on a 30-year.
What happened to all the buyers out there? People who said they were going to come in and yields were going to come in softer. There is a question of what's behind this. Is it really inflation expectations, or is there something structural going on at a time where real yields on the 10-year Treasury are climbing toward the highest levels going back to March of 2009?
10-year real yield just popped 1.98%. If we go into Friday here and go into the weekend and pop over 2, that's a huge deal.
The data's better in America against expectations, and particularly relative to what's happening in Europe. President Lagarde in the news conference yesterday, very, very sluggish. The euro just about reclaiming 107 right now, positive by 0.1%. The euro just a touch stronger here, but at the moment, we've been looking at 106. In fact, on my screen, I think that's wrong, where the single currency is on that board. On my screen, I've still got the euro 106.56.
Well, you round it up. It's a 2-digit. It's the difference between a surveillance 4-digit analysis versus 2-digit.
Well, I always want the 4 digits, TK. It's foreign exchange.
Totally agree.
On my currency pair right now, 106.57 on the euro. Just about positive on the session, but down on the week, potentially for a 9th consecutive week. And the move in crude is where the story's at for me. Commodities, WTI, Brent. WTI at the moment, 90.65. Brent crude, new highs for the year on Brent crude at $94 a barrel, Lisa.
And this is on the heels of what we saw, which is better than expected data in China. And that's the worst thing of all worlds, because on one hand, it's going to feed into demand for oil, but not enough to juice growth. This is sort of why Europe is in the midst of a toxic
Unreal.
brew.
A very, very toxic brew, Bramo. Under surveillance this morning, the United Auto Workers starting an unprecedented strike at all of the big 3 automakers. UAW President Sean Fain saying, quote, "This strategy will keep the companies guessing. It will give our national negotiators maximum leverage and flexibility in bargaining. And if we need to go all out, we will. Everything is on the table." President Biden said to address the strike later on today. Tom, no time, but from what I understand from people down in Washington, no time because they're not sure what they're going to say about this just yet.
I wonder if he's capable of stripping away the mythology that he grew up with, because the strike that I saw last night is not the mythology of the American labor economy. It is a new phenomenon we're seeing this
Muted
morning.
price action this morning. Do you think it's a coincidence, Lisa, that Tesla's having its best week of the summer, going all the way back to June?
I would guess not. And I would guess that also Tesla's been absolutely rocking it on all sides, no matter what happens. So they've had an incredible year. But this to me is really at the crux of the issue, which is the electric vehicle makers and the ones that aren't unionized are going to cash in on this. And that's the real risk for GM, Ford, and Stellantis.
Very scientific.
I can't even say it.
I see a lot of Teslas on the street.
Yeah.
That's a fact. That, small matter.
Agreed. And the stock is positive this morning in the pre-market. Our next story from ARM, climbing 25% in its trading debut. The chip designer raising $4.87 billion in the year's biggest initial public offering.
Woo.
The company selling 95.5 million ADR shares at the top end of the range, 47 to 51. Do you think it's accurate, Lisa, to say they raised money off the back of this IPO, given the nature of the transaction?
Yeah, basically it was a fundraise, right? But it was also a marketing tool. I mean, you have to imagine this.
Yes.
But to put some numbers on it, they could have priced it at $52 a share. They priced it at $51 a share. Masayoshi Son came out and said, we don't want to add the extra dollar because we want it to be a big pop, big boom. Look how well SoftBank is doing. Our tech investments have been rocking it.
Okay.
They left $100 million on the table because
This is some really good research on this about how these IPOs,
That's all I think of.
But how these IPOs work out. There's been a lot of good research on this as well. Guess what? There'll be a first earnings call. That's when it starts.
To Lisa's point, they want us to talk about ARM and not WeWork and all the other things. Disney cutting its target for streaming subscribers. The company announcing it will fall tens of millions of subscribers short of its last publicly stated 2024 target for the Disney Plus franchise. This according to people familiar with the matter. Returning CEO Bob Iger saying the company will no longer provide subscriber forecasts following a similar announcement made by Netflix. It is not going well, TK, for Bob Iger this time around?
It's a broken system, but frankly, creative Iger is the one to help out financial Disney. I'm fascinated by this. I was thunderstruck by what was it, the ABC, should I say rumor or speculation of shipping out ABC to
Reporting.
Nexstar?
Reporting encouraged by the man himself, I would suggest, by indicating that some of these divisions aren't core to what Disney is trying to achieve.
And I've told this to Paul Sweeney, who's expert on this. I'm just absolutely baffled by it. You know, I just don't know what they do. I look at home at what gets used. Disney Plus doesn't get used. That's a fact.
Well, but how old are your kids? I mean, that's a key aspect
Can you run a streaming channel off 8-year-olds?
The point. Well, I'll leave that there.
Son.
It's a good question. I think a lot of people would say, yes, you can if you look at the consumption during the pandemic. There is a question, though, going forward of how whether Disney is basically kitchen sinking it right now and trying to streamline everything with the focus on the parks business and the cruise business, which I know you guys are purveyors of. But this really is going to be throwing it all at the door so they can start over.
The parents in the control room, our producers already writing in the answers. Yes, Tom. Apparently you can. Just a bit of feedback there, TK.
A little bit of constructive feedback. Tom Keene, the pinata. Joining us now amid this flow, and we're watching from the White House to see when the president will speak, is RJ Gallo, Senior Vice President of Federated Hermes. And we're thrilled that he could join us this morning because he's got the smartest bond note of the week. RJ Gallo knows that one of the efficacious things to do in bonds is look at the Bloomberg Total Return Index and see that for all the talk, yap about coupon credit spreads, blah, 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 bonds have gone nowhere. RJ Gallo hypothesizes that bonds are not back. Thank you, RJ. I looked at the chart off your note, and I was thunderstruck how the blended price of bonds is really not advanced. Is it still a bond depression?
Well, in the note that you were talking about there, I made the point that when we started the year, we felt that it was going to be a favorable one for bonds, and clearly it's fallen short. The Treasury index is basically at 0. The ag is up, I think, 0.5%. So yes, it's been disappointing. I would also note glass half full. The double-digit losses of last year, recall the ag was down like 13%, are clearly behind us. And looking forward, we're much more optimistic that the time for fixed income giving you sort of low single-digit positive returns and acting as a powerful diversifier in your portfolio, that is in fact back. With yields at the highest of the last 12 to 15 years, we think value has been restored, and fixed income investors should think about extending some duration, getting out of cash, legging into fixed income will be a good move over the next 12, 24 months.
Okay, 12 to 24 months, I'm going to get going. When do I get back to the regression line that I had for 30 years? You know, the Bill Gross, great moderation, price up, 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 up. How many years is it going to take to recover from what we've seen the last 2 years?
I hate to say it, but I think that the zero lower bound, presents a significant wall to anything like the returns that we saw over the 20, 30 years leading up to the pandemic. If anything, we believe that it's quite possible that equilibrium yields are higher post-pandemic than they were for the decade plus prior. It'll be interesting to see if the Fed goes there with its long-run dot, maybe inching up in the dot plot closer to maybe 3, maybe a little higher. If you look at forward curves, you can see that the market is there. The market believes equilibrium yields are higher. And in that sense, it's going to be a while before we see big price returns from taking a fixed income, high quality fixed income investment. Instead, I think we'll probably be looking for oscillating markets around a higher equilibrium, which will still provide a nice return and balance for your portfolio, but it's not apt to be double-digit price returns anytime too soon.
Is this higher yield driven by inflation or driven by something else, whether it's a budget deficit that spooks investors or a changing central bank regime in Japan?
That's a great question. I think that there's been a number of factors that have shifted us towards what's probably a slightly higher equilibrium yield environment. The budget deficit's a big part of it. Sovereign debt has exploded. We've got a lot of debt to roll over. Obviously, we have structural imbalances here in the U.S. that no one wants to deal with in Washington. So that's one factor. I think on the favorable side, a lot of talk about AI, about technological innovation. In the long run, when you have technological innovation, your potential growth rate goes up. Higher potential growth rates, higher equilibrium yields. That's actually a positive thing. That could put more people to work. Of course, you've got to talk about the issues of displacement, who gets jobs out of the new technology.
who loses them. But ultimately, I think higher potential growth rates, larger budget deficits, and some pushback against internationalization, the pushback against the global trade marketplace that helped to produce low inflation and low yields prior to the pandemic. Now you're talking about onshoring. That's a big change. And I think ultimately that too is probably going to lift yields a little higher, as the disinflationary impact of globalization might not be as strong as it was in the prior 10 or 15 years.
That's in the years ahead. In the here and now, we're looking at a UAW strike that's roiling Washington, D.C., but also Detroit. Does that factor into your yield call? Does that factor into the bond space as you look out to understand the growth as well as the inflation picture?
Yes, it does. I mean, it obviously it cuts in two ways. First and foremost, these workers are looking for raises. It's no surprise. We've dealt with the highest inflation in 40 years. A lot of workers are looking for raises. That makes sense as they deal with the higher cost of living. You stop there, you would think that strikes have to be inflationary. Ultimately, however, you got to consider the near-term impact of a strike is less production, less economic activity, and the multiplier effects that occur in the local economies around these three plants. And if it extends to more plants, that economic impact only grows. I think ultimately this idea of empowered labor across the country is very predictable at a point in time like this. I think it's challenging for the White House, as you guys have been saying. I think from an economic standpoint, I'm focusing a little bit more on the growth headwind that it's going to produce in the near term. It's not the case that every dollar of raises that the auto companies are going to give these workers to get them back on the job, that's going to be simply passed through one for one into higher prices at the dealership where we buy our cars.
I've got an equity question, RJ. Can I squeeze it in? Because I've only got about 30 seconds left with you. Do I want to avoid industries that are witnessing, like we see in airlines, like we see in automakers, this powerful movement from labor?
In terms of what industries you would go to avoid it?
Should I avoid the airlines? Should I avoid the automakers purely because of the evidence of labor market power? Should I avoid those industries?
Well, I do think it's clearly a margin compression story in these industries. As I was saying, the automakers won't be able to pass through to price one for one the raises that their workers are going to get. I clearly think that is a challenge. In terms of sector rotation on the equity side, I don't know if I would necessarily avoid it. That's really not my main area of expertise. I can tell you on the fixed income side, we've been relatively cautious on investment grade corporates and high yield because we think a broad-based margin compression is a story that's still out there, and we're not as optimistic on corporate profits in general. I would focus on that from a broader macro perspective.
Interesting. RJ, thank you. RJ Gallagher of Federated Hermes on some important issues. If you're just tuning into the program, welcome. Equity futures here positive by 0.1%. Lauren Goodwin of New York Life Investments joining us in about 45 minutes time. These are really, really important questions. How we think about some of these issues right now, Tom, not just margins more broadly, but the viability of some of these industries. Helene Becker on this program yesterday talked about the prospect of one of the big airlines failing, Tom, because they couldn't address these issues in a way that would be profitable for them.
I was wrong years ago. I used to believe in diversification, and Peter Lynch called it diversification. Peter Lynch correct, Tom Keene wrong. And in terms of sectors and industries, you're 100% right. The way you make money is by not losing it in value-trapped, dead sectors.
Well, the concept of diversification is changing. And I think that that's really becoming clear. It's those that are hinged to an economy more subject to some of these negotiations and those that are newer and more divorced from it. It's almost the new and the old economies at war with one another.
Yes.
The revenge of labor market power in a big way. Geetha Raghunathan, US media analyst over at Bloomberg Intelligence, will be joining us shortly on the forecast or lack thereof from Disney+. That's next from New York. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
On the next episode of Hello World, meet the women driving Kyrgyzstan's tech revolution.
This is the first satellite in our country.
And some speedy horses. Watch Hello World Thursdays at 8 p.m. Eastern on Bloomberg Originals or 10 p.m. Eastern on Bloomberg TV.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally. We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Chapek overspent on streaming. He basically was chasing subscribers, not profitability. It takes time to turn that around. You have to buy in Hulu. But I think what we would say, and I think it's fair criticism, is that the communication out of Disney since Bob has come back has been very poor, right? They basically have thrown out a ton of ideas and they've teased the market without delivering on what the story actually is going to be.
Michael Nathanson, the senior research analyst at SVB, Moffett-Nathanson, more confusion this morning. Disney cutting its target for streaming subscribers, the company announcing it will fall tens of millions of subs short of its last publicly stated 24 target for Disney+. Your equity market shaping up as follows on the S&P 500. Equity futures still just about positive by 0.1%. Yields bleeding just a little bit higher by 3 basis points to 432. Crude in the 90s. Have we got to get used to that? Crude 90, wow. 61. In the FX market, the euro 106.58 and positive 0.1%, coming off the back of the worst day since July for the euro, Tom, in yesterday's session, given how decent the data was stateside and how bad things look for the ECB over in the eurozone.
Tom is wrong. Did you notice that?
That's a new one.
That's a new one. Disney Plus, Animals Up Close, Elemental. It's a Pixar movie.
Okay.
Didn't do that well.
The mail is coming in. Seth Rosen, thank you, Seth, so much for writing in this morning. He says, Tom, you're wrong. And I guess Disney Plus is a big deal. I don't buy it, but
so
I'm
you're
wrong.
surveying 8-year-olds this morning.
The 8-year-old cohort is
the
they
children
say
of the
that
parents in the control room are weighing
Disney
in.
Plus are doing better than good. We're going to digress from huge and seriously, we still don't know when the president's going to speak, right?
No time just yet. No.
Yeah, okay.
I'm not sure if the president knows what time it's going to be.
We're going to go to Disney Plus and the intractable issues that Mr. Iger faces. Geetha Raghunathan joins right now with Bloomberg Intelligence. And Geetha, to me, this is about fancy companies flying in fancy McKinsey, BCG, Bain people, the strategists to save the day. What would the strategist say this morning to Mr. Iger? Let's pick on McKinsey. McKinsey Media shows up. What do they say to the leader of Disney?
Well, they already have. So good morning, Tom. Thanks for having it. So they already have a lot of things that are going on right now at Disney. So you have, on one side, you have the streaming business, which, as you just pointed out, is losing subscribers. But then the whole narrative there has really kind of shifted away from subscribers to profitability. So that somehow Bob Iger has to show that this business is going to be profitable sooner rather than later. We know Netflix has kind of already set the template in the market. There is a blueprint for streaming profitability. So they have to figure out a way to get there. But more important for Disney right now is to somehow kind of show the market that they have a plan for their linear TV networks. And the linear TV networks have really been in the news a lot over the past few days, whether it was that dispute with Charter and more recently, all of these news reports about them looking to kind of dispose off some of their networks and multiple bidders emerging. So there's a lot going on there, but I think as soon as Mr. Iger can kind of clarify the narrative, it's all all going to become much better.
But Geetha, you know, we had Michael Nathanson commenting earlier, and I look at Moffett Nathanson for 10 years has talked about cord cutting. And they were correct, and I believe Moffett Nathanson would say, you know what, it actually happened faster than we thought. Is Iger listening to the public? Is Iger listening to Seth Rosen?
He absolutely is, and he's been forced to. I mean, the data is staring at you, you know, in the face. So there's no way to sugarcoat the fact that the industry is losing subscribers. We've lost roughly 25 to 30 million subscribers over the past, 5 to 10 years. So that is, the writing is on the wall. Bob Iger has said that, they are willing to take the steps. He has actually publicly said that the linear TV business is no longer core to Disney. And if you just kind of look at the Disney profitability profile for 2023, out of the $13 billion that they will generate in profits this year, 75% of that is going to come from parks. So they really know where they need to kind of focus. It has to be on the parks business and getting that to even higher profitability. And it has to be, reducing losses in the streaming business, as well as kind of keeping, the linear TV business in cruise control, because the streaming business will lose close to about $3 billion this year.
Today, it seems like stock investors are getting the message, Geetha. We are seeing a 0.9% pop in the Disney shares ahead of the open. It does seem to be like that is the narrative that's coming out of this, right? Especially not giving subscribers for Disney Plus, which is a successful platform, but not necessarily emphasizing growth. And then the news about ABC. Does this mean they're not going to be investing in content, that they're hoping to save money on that front?
They definitely, that's a great point, Lisa, and they definitely are looking to save money on content. So they had initially projected about $31 billion in content costs for 2023. They've actually taken that down to $27 billion. So there's already been some, reduction on that front. Of course, that is largely in part due to the Hollywood, the dual strikes. But even going forward, I think they are going to take a really, really disciplined approach. Bob Iger has openly said that, they're not going to be greenlighting projects left, right, and center, whether it's for the film business, whether it's for the TV business. So they're definitely taking a hard look. And remember, they haven't really performed all that well on the content front as well, especially you brought up Elemental. That's a great point. We've seen a string of misfires from the Disney studio. This is one of the best performing studios in the history of films. And so it's kind of been a little bit of a disappointment, but I think he is kind of really looking to revamp all of the content franchises right now.
At the same time, ESPN, long considered a contender for a sale by Disney at a time when it was at the heart of a dispute with cable over the past couple of days. Is that still for sale? Is that still the rumor out there, or is there going to really focus on expanding and fortifying this, because sports really are the heartbeat of all of our media content?
I absolutely agree. I actually think it's the latter, that they will look to keep the ESPN network. What they're trying to get rid of is the rest of the linear network portfolio. They do realize that they have a lot of opportunity with ESPN. They're already paying about $9 billion every year in sports content costs. There's a huge advertising business there. There's a huge affiliate business, and I think there is a lot of potential. So I think they will look to keep ESPN, dispose off the rest.
Yeah, but the heart of the matter, as you led with, Geetha, and you're expert on this, is everybody needs to be Netflix. So Disney Plus picks up the Australian animation Bluey, and it's Bluey Heeler and his sister Bingo Heeler, and that's all great. Can Bluey from Australia deliver for Iger 21% EBITDA margins?
It actually can. It is going to take a little bit of time. What Netflix has achieved has been over a period of, 10, 12, 13 years. Remember, just a few years ago, we were criticizing them for burning about $3.5–4 billion in cash. So it's taken a while. So, yes, they have kind of set the template, and Disney needs to take a page out of the Netflix playbook. So it knows exactly what it needs to hit. And I think they will. By fiscal 2025, 2026, we are going to see this business generate fairly good margins and ultimately get to that 20–25% margins. I think it's absolutely achievable, but of course a lot needs to be done before we can hit those targets.
Geetha, let me share some of my emails with you. Hi Jonathan, the price of Hulu, no ads plus live TV, Disney Plus, no ads, and ESPN Plus with ads will increase on October 12, 23 to $89.99. TK, $89.99.
Wow.
A month?
YouTube is...
$89.99
a month.
$90, I believe, is what we call that.
Yep.
That's like a barrel of oil.
$89.99.
You can get a barrel of oil in Bramo's living room.
That's where we're at.
$1,000 a year, more than that.
That is where we're at.
Bramo does the math. It's ridiculous. It's ridiculous.
Agatha, can they put up prices anymore?
I mean, it's going to be tough, but actually the recent deal that they did with Charter suggests that they are now willing to kind of rebundle all these services. I think in many ways that was kind of a landmark deal. You know, where we are coming, I know it sounds almost silly and ironic, but yes, there is going to be the great cable rebundling. Charter was the first step. I think we're going to see many more of those deals happen.
Geetha, thank you. Geetha Ranganathan there of Bloomberg Intelligence. Throw in the cost of broadband, TK, and we're back to where we were, aren't we? Maybe more.
We're so back to where we were. This is the one discussion, I've said this to Paul Sweeney, where the pros like Geetha Ranganathan, Michael Nathanson, Rich Greenfield, and the others, the confidence in their voices that they're going to succeed to get the income statement where it's supposed to be. I wish I could get the reach to get there. It's the one thing I can't get across the canyon, the Nathanson Canyon.
I'm glad you mentioned Michael Nathanson, because he was the one that said that the new model for sports and the new model for cable is the old model, which is bundling, and that is
So
worked.
what are you going to do with $90?
So why stop it?
What are you going to do with $90 a month? That's stunning.
I'm looking elsewhere. I mean, what are we paying for? Peacock, Paramount. Peacock has the Premier League football. Paramount has the Italian football. Then you've got Netflix. I gave up Apple Plus.
Are you pumping over $300 a month?
TV, not Apple Plus, but gave up Apple. It's expensive, let's put it that way.
It adds up.
If you want to watch all the sports, if you want all these different things, it adds up pretty quickly.
I went through 2 weeks
It's
ago
my
and
own
got rid of a
streaming
bunch of
bundle.
them.
It's your used car.
My streaming bundle is a mess. Barry Knapp is not a mess. He's from Ironside. He joins us next here in New York. Looking forward to that conversation. Equity is just about unchanged on the S&P from New York. Good morning.
They're brimming with sensors. There's several cameras that look out at your world because we're mapping your physical world so we could put the content in there. There's several cameras looking at your eyes so we know where you're looking in your physical world. And that's a lot of data. That's a lot of very personal data. There's a number of other sensors on the device that are needed to make it work in the way it does. So we feel strongly that, first of all, people should know what these devices can do. And since we're at the beginning of the curve, let's work on the right guidelines and put those guardrails in place now versus letting it out of the bag and trying to rein it in, several years from now.
So what rules would you put in place, and who should make up and enforce the rules?
I think it's definitely a public-private discussion, but it's a very complex technology. So I actually spend quite a bit of time in DC talking to folks, saying, just educating them on what it could do. But I think first and foremost, the data that it collects, there needs to be an understanding, the user needs to understand the level of data that it's collecting, and then be the one who says where that data goes.
And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
We've had the market analysis. We're going to go get straight to some breaking news. We'll have a full roundup.
Going through some of the numbers and what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping. Look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights.
How has that shaped your strategy for the bank?
Is this a new normal? Is this like a catalyst?
Do you think we're in a new phase for dividend policy overall?
That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
It's not that the US is roaring, it isn't, but it isn't yet falling into recession.
Can the US recession be deeper than Europeans' recession in the first half of next year? That's certainly possible.
The risks for stagflation are certainly higher in the euro area than they are in the US.
Less hawkish policy could fuel yet more gains in the US equity market.
I'm not worried about an organic slowdown in the US economy. There's no sign of demand falling off a cliff.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio and television across America, and it is an America with an auto strike. The president will speak, and John, the backdrop suddenly $94 a barrel oil.
The words of UAW, we will strike all three of the big three all at once. TK, muted price action for the big three in the pre-market this morning, and a limited walkout across three plants. The amount of workers, TK, 12,700 people. But to your point, the president will address the nation, Detroit, and the auto workers a little bit later today. What does he say when he also says, leading into all of this, that he is the most pro-union president this country has ever seen?
His downside, and I'm sure Gene Sperling, among others, is advising him, is not to go back to the mythology of Flint, Michigan, Buick City, 80,000, 30,000, 40,000 employees. As you say, this is a contained labor action, but it could go larger.
And it's not just this industry, it's the airlines as well. And we're questioning the viability and sustainability, Tom, of some of these companies if these labor unions get what they want. What happens to Detroit's big three? How sustainable is that industry in America with the kind of labor contracts that UAW would like Ford, GM, and Stellantis to sign?
And that goes back to what we witnessed yesterday in the chaos of the ECB and all, which is suddenly we're having these discussions amid a real yield, a more normal yield environment. That at least it goes back to the 90s. I mean, it is a different bond market now than 5 years ago, 6 years ago.
This conversation highlights how confusing this economic moment is, because you're seeing the crosswinds of both technological advancements, changes with deglobalization and reshoring, coming to a more inflationary moment, but a decelerating economy. How do you put those things together and get any kind of conviction whatsoever? Yes, yields are higher now. You have some people, Bob Michael over at JP Morgan Asset Management, saying it's a buy, go in, all in, they're going to come down. And you got a lot of other people, including BlackRock, saying not so fast.
I haven't talked to Amory Horton or Joe Matthew about this morning, but John, is the easy path for the president to do a photo op at the White House next week and gather together everyone, you know, to put Barr at one end of the room and the head of Ford Motor at the other end of the room, like they had Musk and Zuckerberg split.
I think boilerplate, that makes a lot of sense. Yeah. Sit on the fence, bring the same sides together, be the guy that unites everybody and tries to make everybody happy. Couldn't agree more. But has he painted himself into a bit of a corner? Can he play both sides? Well, can you be the most pro-union president ever and sit on the fence and try and strike a deal that pleases everyone?
You mentioned this late in the last hour. Is the floor, somebody had a great quote on this yesterday I stole, is the floor of the union, even in these three states, these three localities, Bronco, Colorado, and Wrangler, is it a red or a blue floor? That's really what the president's speech is today.
There's still a battle for just that, Tom. You mentioned energy. Energy at the epicenter of absolutely everything we're talking about. The transition away from fossil fuels to EV, how much that's going to cost. Energy at the epicenter of retail sales and PPI yesterday. Energy at the epicenter of the upgrade to the inflation outlook out of the ECB. Energy at the epicenter, Lisa, of the downgrade to the outlook from Delta, from American, from Spirit Airlines this week. The surprise of the last month is crude back in the 90s.
Yeah, what we just heard from Sarah Hunt was that maybe it's even too fast for even her oil investments, her energy investments, because it creates demand destruction. What this shows is which economy, which companies are strong enough at a time of waning demand in certain of the hottest industries, which are strong enough to sustain their growth, even in the face of the headwind of much higher crude prices.
Brent crude, 93 and 95. Your equity market more broadly on the S&P 500, just about positive by 0.05%. TK WTI, $90.50 this morning.
Oh, the WTI price is there, and good morning. Javier Blas over in Europe, look for his article. I'll get it out on Twitter here as he says the Saudis work out off Saudi Arab Light to $100 a barrel. Let's start strong in this hour. Barry Knapp joins us, Managing Partner, Director of Research, Ironsides Macroeconomics. He drove a VW Rabbit years ago, 3 OPEC things ago, whatever it was. What does the overall stock market do with a jumble, not so much of a labor strike, but with a jumble in reality of $94 oil?
Yeah, the oil situation's fascinating. One of the things I wrote about last week that I think some have started to explore a little bit but haven't really thought all the way through is that for 5 decades, the correlation of the price of oil with the dollar was negative. The dollar was the single biggest marginal contributor to our current account deficit. It's what originally pushed us off the gold standard. If you think about decades when the dollar was decidedly weak, the 70s and the O's, it was largely a consequence of running these huge energy deficits. Shale flipped those relationships completely on its head, and the dollar now is a petrocurrency, right? And I've described it as such. So that in and of itself has big impacts on financial conditions in the U.S. and in Europe. Where I'm going specifically with that is, as the dollar, as oil goes up and the dollar goes up as a consequence, it actually, because we still run massive goods deficits, you get a big offset in import prices. We're going to see that number this morning. So that actually tightens financial conditions, the increase of the dollar as it goes up. Additionally, because Asia is so vulnerable, China and Japan are so vulnerable to higher oil prices now, it actually makes them better sellers of treasuries and puts pressure on the back end of our treasury market. Again, a tightening of financial conditions. But the opposite is true in Europe, right? They run current account surpluses. They're short oil. So financial conditions loosen as the price of crude goes up, meaning there's more chance for energy price pass-through. It's a more intractable problem for them. But for the U.S., a higher price of oil is no reason for the Fed to respond, tighten policy as a consequence. They're going to get big offsets. So this change in the correlation of oil is a very big deal, I think, for these flows in global relationships.
Give me the FX call then. Parity on the euro? Is that what the call is?
Yeah, essentially. And, as I met with clients this week, being back in New York, the one thing that really scares people is, back end of the treasury market releasing. I had a target that we would go to 4.25, 4.5 or so on 10s, 2% on reals. This is roughly where I think they should be given the Fed's holdings, right? And I think we'd be 100 basis points higher if the Fed didn't own a third of the treasury market, mortgage market, and agency MBS market. Roughly where we were pre-global financial crisis. But given their holdings, I think we're in the right or the range of fair value. But people are concerned, and I don't think it'll be yield curve control and the Japanese suddenly going big bang and saying, yeah, we're done with all this, we'll raise rates. The bigger concern would be that things get unruly in China. They let the RMB go to 8. They wind up being significant sellers of treasuries. And next thing you know, we have 10s at 4 3/4 or so. So that's
30s. You give me the FX call. We're rocking now. Give me another one. 440s on 30s right now. What are you thinking about?
Yeah, I think they're in the range of fair value, and they ought to stabilize. I do think the growth outlook's likely to deteriorate, so I'm somewhat sympathetic to Michael's view, Bob Michael, that is. It's not going, I don't think they have any chance, tens, that is, going back to 3, but I could see them rallying to 3 3/4. But then we have this, oil, currency, pressure on Asia influence that does create serious downside risk in rates. So that would be... Listen, I think the S&P is going to 4,800 by the end of the year. I think that we're going to have some weakening of the growth outlook, but the Fed ending and starting to really price in cuts next year. It's in the Fed funds curve, but it's not in things like the spread of mortgages to treasuries. So there's room for further rally through the end of the year. But the risk, to my call, is that the back end of the treasury market has an impulsive move another 25 to 50 basis points higher.
I want to build on that idea of parity between the dollar and the euro. What does that mean for risk appetite more broadly? I mean, you do see the S&P going to 4,800, but this comes at a time of rising long-term yields and a souring European backdrop. Is that good for risk?
I think the real risk to risk, right? The real risk-off episode comes with weakness in Asian currencies, not so much the euro. The euro dollar cross is so big, even if it went straight to parity next week, that would be something else. But the probability of having that big an impulsive move in dollar euro, I think, is fairly low. So if it drifts there to parity by the end of the year, I don't think that's a risk-off sort of a move. I think RMB going to 8 is a risk-off move.
And you mentioned if China sells all the rest of its treasuries, you could see yields rise up further, regardless of the reason of why. If we do get a material shift higher in longer-term yields, divorced from any Fed policy, what does that do in terms of really creating a feedback loop at a time where 10 years ago everyone was saying that the market was so distorted from zero rates? Are we going to finally see that transmission mechanism?
Well, we're headed down that track anyway, Lisa. I think where you're going with this, and certainly where my brain went as you were asking the question, was I've been describing the macroeconomic situation as an unstable equilibrium, right? So if you just think about this in terms of the large non-financial corporate sector, which has largely termed out its debt, look at the duration of the investment grade credit index. The household sector, again, has largely turned out their debt. The MBS duration has never been longer, right? So we know the effective mortgage rate is 3.30 or something. So most of the household sector is, immunized from higher rates for a time. The large non-financial corporate sector is, but the banking system surely is not. The small business sector surely is not. The highly leveraged sector, duration on the high yield index is falling. We've got a tremendous amount of commercial real estate loans to roll in 24 and 25. It's often said that the yield curve can signal a recession or cause one. We've only had this deeply of an inverted yield curve 3 times in our history: October of 73, Dece of 79, and Dece of 80. This is an existential threat to small banks. And you look at bank holdings, the weekly Fed HA data, you see holdings of treasuries plunging. This is sell what you can, not what you have to. I remember it distinctly because, of course, 15 years ago today was the death of Lehman Brothers, where I had worked for 19 years at that time, right? So
I can't believe it's been that long, Barry.
It's amazing.
Isn't it nuts?
Right? It just occurred to me. I was coming on the 15th anniversary.
Barry, this is one of those conversations I'm going to go home and re-listen to a little bit later. It's fantastic to see you right now. Thank you, sir. Of Insights Macroeconomics. If you are just tuning in, welcome to the program. The S&P 500 here, positive by 0.1%. Lauren Goodwin of New York Life Investments joining us in about 20 minutes. And right on cue, Barry, you mentioned the effective mortgage rate. 360. We've got the chart as well. It's an amazing chart. Right. TK down, 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 and then just inching just a little bit higher, back to about 360. So this is where the effective rate is. We know where mortgage rates are, in and around 7%. If you go and get one today, this is basically the average rate on the outstanding pool of mortgages at the moment, Tom.
Yeah. And what's very important here, and it's hugely, hugely nonlinear. It gets going, and then the ramifications, if it continues to move higher, to the tension Barry said out farther out the curve, it's not linear. There's gonna be some real pain if we get the breakout.
Only
higher.
about a tenth of outstanding mortgages at origination are paying about 6 or something like that. And this is going to take a long, long time to see that 360 shift higher towards the 7, if they're even at 7 in years to come.
The only way it works out is to get a substantially lower yield. All of a sudden, yields come in and everybody refis at 4% or something.
Barry, this was great.
June.
It's good to see you, mate.
Next June.
As
All right.
always. Henry Trays of Veda Partners is coming up next. There is a strike in Detroit for the Big Three, and we're waiting to hear from the President of the United States. From New York City, this is Bloomberg.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays. From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Wall Street is waking up. Europe is already trading. And starting Monday, Manus Cranny and Danny Berger will make sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. Take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, premiering Monday, only on Bloomberg.
From day one, we told these companies, we don't expect them to delay and drag things out, and that's what they chose to do. We didn't want to be here. We want a fair agreement. We want fair economic and social justice for our members. That's what this is all about. They've had a decade of record profits. When they're profitable, it's all theirs. But by God, when workers ask for their fair share, it's the end of the world.
That was UAW President Sean Fain joining the picket line in Michigan. There is a strike. We will strike all three of the Big Three at once for the first time in our history. That's rocking Detroit this morning. It's not rocking this market. Equity futures on the S&P just about unchanged on the S&P 500. Yields a little bit higher, up by 3 basis points, 432 on a 10-year. And in the pre-market, if you look at the Big Three out of Detroit, Stellantis, GM, and Ford. The muted price action, Tom, still pretty muted through most of this morning.
It should be. It's a surgical strike. Bramo nailed this yesterday at 10 p.m. It would be something different, and it is. Review it, John. It's 3 different states, 3 different models. It involves, what, 12,000 employees?
12,700 across 3
It's
plants.
like a mini strike. Compared to the Teamsters, UPS, this is a nothing burger.
Important piece of this, Tom, is UAW members will get $500 a week from the union in strike pay. There's only so much money. So if you want this to last long and hit hard, you have to do this strategically. So you start with 3 plants, 12,700 workers. If you want to up the disruption, then you start thinking about
Do
the
we have a
F-150s.
win on that? In all of our reading, do we have, like, when do they go to F-150?
No, not really. And I don't think they want us to have a reading on it.
Right.
It's the unpredictable side of this from UAW's side that gives them a little bit more leverage in talks.
How's the president spin this? I mean, he's going to have a script, obviously. You know
Lisa
he's going to go
offered
off
the
script.
perfect statement, perfect boilerplate for any president to issue to bring both sides together. The problem is, Bramo, as you know, once you've gone around saying you're the most pro-union president in the history of this country, can you get away with just saying what any traditional president might say about a dispute like this one?
Maybe that's the reason why we haven't heard anything yet, because we do think that there's going to be some kind of statement, but hasn't been established when. Is it because they don't know yet? Is it because they're still writing that statement?
Without a doubt, they don't know.
I think he's going to fall back on the mythology.
They should know.
They should know.
Because they should have had a range of options lined up for whatever the outcome of these talks were going to be. I don't think we've got a time. We don't have an understanding of what either.
My bet is he's going to fall back on the mythology of his youth and of Scranton, Pennsylvania. Part of that mythology, of course, is going back to the 30s, as Anne-Marie Horton mentioned earlier. And what we know for certain is the UAW has a heritage, has a history. And so on Decatur Street in New Orleans, John, does Aunt Sally's pecan pralines.
Nice.
Back to the 1930s.
These look good.
Bearing gifts this morning from New Orleans on television. It is Aunt Sally's pralines. They're for Bramo. And here you go, Lisa. And,
just to be clear, we're not saying Sally, we're saying Sally.
Not Sally's. It's my accent.
Was that a southern accent?
No, I don't have a southern accent.
Do you want to do the calorie count?
On radio, it's like a calorie count on radio. That's all you need to know. Henrietta Trace joins us here. Encyclopedic on Washington. And very importantly, Henrietta, in this moment, this is a president who's got to come up with a new statement for a president on labor unrest. What's it sound like?
If you're interested.
I think you're exactly right, falling back on that Scranton narrative and speaking to labor unions the way that this administration has their entire term. We've done this before. They have a huge success rate, so I think there's a lot of maybe not surprise in D.C., but it's a different circumstance now that there's actually striking happening. And I assume it's DEFCON 1 up there, and they're all going to work to resolve this.
What do you think his response is going to be? Now, let's dig into this. He already cut off the railroad workers from striking. He can't do that with this. Even though they did that, they still went around saying they were the most pro-union administration in the history of all administrations in the United States of America. I'm not sure how you can be so pro-union without giving people the right to strike. Now they're on strike. Shouldn't you be supporting them?
And it's interesting to watch because there's a number of Democratic lawmakers in the Senate and the House who are going to join the strike, right? So you have this situation where the White House is obviously going to try to get the strike to conclude, but there's a host of Democrats who are actually going to strike with them. So it's a bit of a two-sided videotape right there.
What about the Republicans? Where should they be coming in, or where are they coming in to try to capitalize on something that's fraught on both sides? Because this is no longer a one-party kind of issue with unions.
It's really not, and I think that Democrats really focus on this because President Trump, when he was in office, was so successful at taking so much of the union vote away from the Democratic Party, and that's a material shift that Democrats have to worry about for the future. So when you see, for example, Trump comment on this, it's really deflective and moving away to electric vehicles. So we're anti-electric vehicles, which is, of course, a big component of this, but we've just subsidized the entire electric vehicle industry substantially, whether through the CHIPS Act or through the IRA. Treasury's working on all those electric vehicle tax credits right now and more. That's what is at the heart of this debate because they need less workers for those vehicles.
Does it look less likely that if the auto manufacturers did run into trouble on the heels of some of the labor pushback and their financial situation did weaken substantially, that any kind of future bailout is off the table the way that it was back in the day?
Oh my gosh. I was in the Senate when we did the auto bailouts. I don't want to hear that again. I mean, not to bring it in, but Mitt Romney is retiring, so maybe we that's terrible. But no, I don't think that there would be another bailout. I don't think that that is something that this administration or America is prepared for at this point. We passed a lot of spending bills. I don't see a sector-specific bailout occurring anytime soon.
2020, union vote, Biden 57%, Trump 40%. At the margin, critically, from 4 years before, Biden did way better. than Hillary Clinton. Where are we now? Drag it forward 3.5 years. Does Biden still have the union vote majority?
I think that when you look at not necessarily the union vote, but all voting turnout, there are other issues that are bigger than just union issues. And we have kept all those tariffs on, which labor unions are in some cases supportive of. The administration has gone a long way towards reshoring those union votes. So I think they stay. But Trump is got a stranglehold on his party, and so none of those voters are leaving. So I wouldn't be surprised if it was exactly the same.
I'm not sure how we can have a viable auto industry in Europe or in the United States without monster tariffs protecting this industry. I'm not sure how it can be viable, given what's happening in China at the moment, the opportunity that they have to produce vehicles at much lower prices, much lower cost than the Europeans. The Europeans are already complaining about that. Isn't that the direction we're traveling in here? That Europe's about to smack tariffs even higher and basically say the same thing as America. You want to sell here, produce here?
Absolutely. I mean, tariffs, state subsidization, domestic subsidization, friendshoring, all of that is very much in the cards. And I think for the foreseeable future, under this administration or in the case that Trump wins.
Have we thought this through about what this EV transition is actually going to look like and how costly it could be for governments, Europe, China, the United States?
I don't think so. And you're seeing that in a lot of the delays of these regulations coming out on clean energy, not necessarily just on electric vehicles, but the solar, the hydrogen, all of those alternative clean energy components are requiring tremendous amounts of manpower at Treasury. And one of the things I hear most frequently is we just don't have the experts to finalize these regs. We're working on it. We know that Commerce Secretary Raimondo is staffing up Commerce with 150, 200 new people to address how to roll this money out, where it should go, how slowly to phase in these changes, how tariff rates should work in conjunction, whether with the EU or with Mexico. Those clean steel tariffs, what are those really about? So they're all connected, but I think it's slow going, and industry is very keen on getting the details.
We're going to be talking about this for a while, no doubt about it. Henrietta, thank you. It's great to see you. Henrietta Trace there, Vader Partners, and thank you for the treats as well. Appreciate that too. Coming up in the next hour on Bloomberg TV, Mohammed Al-Aaron of Queen's College, Cambridge, right here in New York City. We'll be catching up with Mandy Zhu and Jim Bianco of Bianco Research. A couple of weeks ago, Jim Bianco said it. He said energy will be at the epicenter of everything we talk about. That was the last time we spoke with him. A couple of weeks later, energy is at the epicenter of everything we're talking about. Equity futures on the S&P 500 absolutely unchanged. UAW shaking up Detroit, but not shaking up this market. More on that going into the opening bell from New York. This is Bloomberg.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Bloomberg surveillance. There is a strike in America. There are some touches to the past. We've got images right now here at Bloomberg on radio. It is the cold blue sky of outside Detroit, Michigan. And this is images of the Michigan assembly plant, what we used to call Michigan Truck. This is where they build the Broncos, and this is part, Lisa Abramowitz, of the fabric the president will talk about. There's all this modern new mumbo jumbo. You know what? Joe Biden wants to go back to Michigan Truck.
Well, and this is the reason why it's such a fraught moment as they do protest. This just coming out from Citi, from Andrew Hollenhorst and Veronica Clark, saying that a UAW strike would affect the auto production, the GDP. Auto production accounts for 3% of GDP, with about 2/3 of that at the big three in Detroit.
Perfect timing. We're going to go to Lauren Goodwin here, but first, Michael McKee drops by today. Do you have any economic data at 8:30?
We have a little bit of economic data. Import prices are out, and they are up for the month of August by 0.5 percentage point, but take away petroleum, and they're flat. So the oil story continues into day two. Empire Manufacturing, just quickly, comes up to 1.9 from -19. It's a tertiary indicator, but it's out there.
Yeah, the tertiary indicator. Michael McKee, with a lot of experience about labor. When the president speaks to the nation today, it's not 1958 Eisenhower and Reuther of Detroit. This is a different story today.
Well, it's a different story. The automakers are much smaller part of the economy, the big three automakers in particular, because so many of the foreign car makers have located plants here, and union membership is way down. But I went back and looked at 1998 GM strike. It's very similar to this in that they struck a couple of plants. But those plants shut down GM production around the country because they made parts, and it was about as many people as if the entire UAW goes out this time. About 180,000 people went on strike at that point, and there really wasn't much of an impact. In the third quarter of 1998, industrial production of cars fell, of course, and in the third quarter, we saw the number of auto workers on payrolls fall, but then they came right back up again, and the cars were sold, and GDP was unchanged.
Mary Barra with David Weston at 10 a.m. this morning. She is the engineer from what I will always call the General Motors Institute. It's not the Kettering, whatever it is, but she actually knows what to do with a wrench in her hand. She was weaned on the manufacturing multiple. So you meet Diane Swank and the rest are at the National Association for Business Economics in Washington. Does that room full of economists believe in the manufacturing multiple in America?
Oh, sure. And as manufacturing grows, it adds more value to the economy than a lot of other parts of the economy these days, because so much of what we do is service industry oriented, and so much of that is also intellectual property oriented. And the manufacturing people are actually making something and
that's a mythology,
adding to the
Lisa, the
economy.
president's going to capture.
That's the whole thing about this strike is obviously the auto workers want a piece of the profits that the automakers have made since they gave up so much in 2008 when they went into bankruptcy. But it's also about who's going to make the products of the future. Is it going to be the guy who grew up in Lansing and knows how to do something with a wrench? Or is it going to be the guy who can program the computer to make the car?
The Fed is also watching this very closely at a time where we're thinking about wage growth. We're thinking about what this means for inflation. How much does it signal that labor inflation is accelerating or becoming entrenched? And how much does this signal a certain desperation at the end of this whole cycle?
Well, it may be more desperation at the end of the cycle. Obviously, we have seen unions get some very large pay settlements. And we did see a knock-on effect in the CPI with airfares going up, which people assume is in part because the pilots got big contracts. But then it's a one-time bump. And the question is, does that have a long-term impact on inflation? Probably not. What you don't want to see is that the automakers then come back and raise their prices significantly, and then the auto workers have to ask for more money, and you get into the wage price spiral of the 1970s. But right now, the Fed isn't thinking it's going to be a major impact on the economy longer term.
Michael McKee, thank you so much. Just terrific. Yesterday as well, in the blur that we saw of economic data yesterday. Out on the left coast, there's an economics program which is not talked about enough. It is the University of Southern California, USC. It is a spectacular program. And one of their ace students of the recent years is Lauren Goodwin. She holds a shingle out at New York Life Investments and joins us this morning. There's no love for West Coast economics because it's all sunshine and roses and happy, and we're in, the sun of California and all that. And yet you're the gloomiest rain cloud to come in from USC going. You believe in a hard landing. How on USC? Where's our hard landing?
Look, the economy never reacts the exact same way in every cycle, but it does tend to rhyme. And when the Fed raises interest rates, you tend to see interest rate sensitive and liquidity sensitive sectors navigate first, then manufacturing, services, and then the labor market. That's exactly the way that the economic dominoes have toppled this time around. The fact that we're sitting, waiting for the consumer and the labor market as those last dominoes to topple doesn't tell me anything about where the economy is going to be in the future. That's actually very typical.
You're at New York Life. It's old, quiet money, all wrapped around this strange thing called an actuarial assumption. Now that rates are back to my ute, not your ute, and we've got an actual real rate, the 10-year right now, 1.98%, up a solid 4 beeps this morning. In the new interest rate world, do we have to lower our expected return because our economics is a new economics?
I think it's an important question, and the answer is yes in some areas and no in others. With forward-looking equity market returns, especially at valuations where we see them now and where we see the economy expected going ahead, I do think it's challenging to expect a 8% return over the next year.
I was looking for 20. Come on.
Well, we've had it over the past couple of years, right? That's part of the challenge for investors. But we do see stronger yield and some structural changes in the economy as a result of pandemic-era programs as being really constructive for portfolio construction and for the yield that investors can harvest in this environment.
Basically, you're actually getting yield for the first time in a long time, and that's been the story. Bonds are back, and this whole question of how much can you capitalize on that. I love this idea from you. Cash is not a riskless asset. Sort of the missed opportunity in long duration at this moment as a risk that people aren't counting on. Why is it a screaming buy for you right now in 10-year and 30-year treasuries at a time where there's a big debate about whether those yields can go higher?
Interest rates can go up for a lot of reasons, and why they go up is just as important as how much they go up. And right now, or in the last couple of months, the run-up in interest rates, long rates in particular, has been a function of supply and demand factors, the term premium, and not so much because inflation expectations have changed meaningfully or that the expected path of the federal funds rate has changed meaningfully. And when you have changes in the term premium, that suggests that rates are likely to be more volatile moving forward. And so actually, I'm not as big of a fan of meaningfully adding duration of portfolio, though I love of what we heard from Mr. Gallo earlier around taking from cash, adding to bonds. But in terms of aggregate duration exposure, we really like a neutral position with short duration in corporate credit, especially high yield, where I see some really interesting structural changes in quality, and adding longer duration in the municipal curve, actually, where curve inversion is less of a challenge and we see it better rewarded.
I'm wrapping my head around what a hard landing means. If a hard landing means what it used to mean, which is there's going to be corporate defaults, there's going to be a lot of distress, there are going to be layoffs, hard to see why anyone would get excited about corporate credit, about equities, about even municipal areas that are going to get challenged with tax revenues.
Well, it goes back to your first point, which is that there is yield that helps compensate for some of the risk. But more importantly, in corporate credit, especially publicly traded and probably exclusively publicly traded corporate credit, government programs during the pandemic have helped companies to shore up their balance sheets, to extend their maturity walls in a way that's very different from previous economic cycles. What's not different is that spreads are likely to widen. I fully expect that. So from a price perspective, you're still taking equity-like risk in high yield. The difference is that you can harvest coupon in the meantime, and because we are not yet...
You're killing me. You're killing me. That's what they say at big insurance companies. We're harvesting coupon. It's like,
you
wheat,
go out,
we're harvesting.
You call the coupon.
You call the coupon.
In the
Let's
fields.
harvest. Excuse me.
We might still clip them actually in the back room.
Yeah, for sure. Yeah, I don't think that they have
And
them.
they store them through the winter.
The big issue here, right now, as you're talking, I'm thinking to myself, okay, this makes sense over longer term, but what a wild card oil is going to be at a time where people aren't really clear on exactly what the drivers are. Is it a bullish signal of demand, or is it a bearish signal of supply manipulation leading to higher prices? How much do increasing oil prices throw off kilter some of your investment theses?
I think that higher oil prices matter a lot, and I think it's both, to answer your question, a bullish signal of the cyclicality that we've seen in the last couple of months, but a bearish signal because higher energy prices, although many would say they're headline inflation, not core inflation, they matter less for the Fed, that's just not true for the real economy. We all pay for oil, whether we go to the pump or whether it works its way through to core prices, through PPI, which we saw yesterday, and through the way that they work their way into the real economy. And so higher energy prices are a major risk. I think it's part of why we saw a rate hike from the ECB yesterday. I think the Fed is going to be paying very close attention to the path of energy prices ahead.
Listen, I want to get back to the core New York life ability, which is to look out long term. The IMF announcement of a 5-year 2028 global growth slowdown. What's your run rate on real GDP in America out to 2028? Model that out. Is it sub 3%? Dare I say, is it a potential GDP sub 2%? What's your vision on that?
I expect that we actually may see higher than 2% GDP growth on a 5-year time horizon. And that has everything to do with the investment that's going to be required both from the public and the private sector with respect to the green energy transition and with respect to the digital transformation.
See how she ends with a USC optimism? See that, all this hard landing stuff, baloney. Dyed-Wool USC. It's a great program. It drives me nuts how, Holland Horst to Citigroup was at UCLA. And the two programs.
We won't hold that against him, though.
You won't. Thank you. We'll leave it at that. Lauren Goodwin going after Alan Holland this morning. She is with New York Life Investments. Lisa, my head was spinning yesterday, and I don't think it's any spinning less today. What's going on?
It's just there are a lot of crosswinds, and trying to really put them together and understand. And I feel like the UAW strikes really highlight just what a transition moment we're in. Because on one hand, you have technological advances changing the conversation, changing the policy, and you have workers with renewed power and renewed clout to say, wait a second, we have not kept up. Where is our profits at a time where you guys just are coming off big profits? And oh yeah, to boot, maybe some of that demand is cooling down. You put these things together, it is a confusing and tumultuous moment.
I like the phrase confusing there because it's certainly the toxic brew that we're in right now. Standard Poor's 500 down 0.1%. Look here, we got to go to ARM. I mean, Farrell got his usual 8,000 shares with the context he's got on the street.
Oh, yeah.
And I got to pop
8,000 shares.
51 to 61. And then, Amy in the control room said it got a little soggy here in the last hour as well.
Yeah, Masayoshi Son was looking for a win, and it still remains to be seen whether he'll get it. I mean, that to me is the biggest takeaway, is that this was a manufactured kind of IPO with a very small subset of the shares being sold, and they were underpriced based on market valuation. They came in at 51. Masayoshi Son said, I don't want to go to $52 a share. If he had gone to $52 a share, $1, it would have been $100 million more in valuation that they could have booked.
With the economics, the finance, the investment, the international relations we do, and of course with the president speaking later today, we still need an announcement on that. Bar with David Weston here in the 10 o'clock hour. Well, guess what? We're going to delve into ARM and cloud and the rest. Mary Barr is going to do this. I know they're doing AI.
She's going to delve into ARM with us. Mary Barr, come talk about ARM.
But she's thinking about it. That's the problem. Joe Biden's going to go out and talk to the people outside Michigan truck, and Mary Barr is worried about AI.
Well,
that's like,
exactly. How do you adapt to new technologies with an infrastructure tethered to the romance of an old economy? How do you do that?
We're going to have to see. It's 8:43, Friday. We're charged. Stay with us. Mandeep Singh next.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
What do you have for skincare for men in their 70s that have a lot of wrinkles? I mean, is there any way to get rid of the wrinkles?
I have a lot of amazing things, but maybe it'll be a little bit beyond skincare.
Fixed Income Fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
We also have a very unique business model that gives us the ability to have a very, very good vision in the future in terms of when people use our products. So relative to our confidence in the outlook, we have a very, very high confidence that the growth rate that we have talked about will be sustained.
That was Renee Haas, ARM CEO. This is not Instacart. This is not one of the companies that have more speculative business models. This is a tried and true, at the heart of some of the transitions type of company. And it got a good recognition, at least in the NASDAQ trading, the first day of trading yesterday, perhaps less so today. We'll get to that in a second. Tom, I do want to just go over some of what we have been talking about through some of the movement that we've seen in the stocks. We've been talking all morning about the UAW strikes, this question around what kind of damage that would do to the big three in Detroit. We can see that the share price of GM, Ford, and Stellantis are not really moved that much. I mean, you could see it coming back even from some of the lows earlier. General Motors shares down 0.4%. Ford possibly being punished the most, down 1.1%, and Stellantis up 0.5%. But I'm not sure what to read into any of this. Whether this is a union that wants to inflict less damage by doing a surgical strike, or whether they're hunkering down for the long haul.
I totally agree with you. And what this is about, I think the team did a great job overnight. We knew this was coming to an extent, and I think the voices that we've had are away from hysteria, OMG, a strike, And the leadership of the president will set the tone for both parties. And we'll see if we go from the focused tension of these three small factories, Bronco, Colorado, and Wrangler, out to something bigger. We don't know.
We also don't understand what the anger level is right now at a time of transition where there is an existential angst about what kind of future there is for some of these jobs. I do think that is a big piece of what's underpinning this. I do want to just bring you a couple of other names that we're looking at and talking about today. Disney, we've been talking about today in terms of whether it is going to be holding talks to sell ABC to Nexstar or possibly somebody else. That was reporting from Bloomberg. We also were talking about how they don't want to give any estimates for Disney Plus, basically hunkering down on the parks business, the cruise line business, the experiences business. Tesla shares maybe getting a little bit of a pop on the heels of turmoil elsewhere. And ARM, we were really wanting to focus on ARM with the IPO that came out yesterday. 25% pop, seeming to gain it today, Tom.
ARM Holdings is a holding company. They're holding a company for technology. To brief us here, Mandeep Singh, Senior Technology Analyst. Mandeep, every single grid I look at of fancy ballyhooed IPOs, out a year, out 2 years, I'm going to be direct. It's painful. Okay, we got the obligatory pop. Everybody got the merch. Everybody went to the lunch. That's great. What are you going to listen for in the first conference call from the Chief Financial Officer of ARM?
Yeah, look, I think what they said at the roadshow is they are in 30 billion chips a year. That's a big number, but what they make as royalty is 8 cents. Now, that's why the revenue run rate is close to $3 billion. They talked about doing their chip design. They've talked about raising royalties. To me, it's still a volume-driven business. As long as that $30 billion is growing, it translates into revenue, but I can't see them expanding into chip design. That's when you're competing with your customers. You're competing with NVIDIA. You're competing with all the fabulous guys, and I don't see that happening.
Mere mortals like me have enjoyed losing money within the volatility of the SOX index. Okay, these guys are in. It's like a Texas Instrument analog back to the back. I'm going to get a lot of hate mail on what I just said, but stay with me here. What you do in an IPO is you warble gaily about revenue. Baloney. Go down the income statement, and can you model out an EBITDA line for ARM?
You can. And look, it's a 95% gross margin business. Yes, they have to spend a lot on R&D to develop that new core, which everyone would want. And that is R&D intensive. Their R&D intensity is close to 40-45%. But this business can generate free cash flow. And nobody doubts that. The question is, how big can the top line get? And that's where, if you look at the last 10-year CAGR, it's been 10%. Whereas when you see NVIDIA, which is selling 100 million chips a year, but at a revenue run rate of over 50 billion in their data center business. So that just goes to show ARM doesn't have the pricing power.
Was this actually an IPO, or was this a fundraising effort?
Well, this, I think, was an attempt to really go to the public market because this is a very important company. And the fact that they don't have the pricing power, they're trying to garner that attention that, look, we are a very important part of all these mega trends that are playing out, whether it's AI or autonomous driving. Everything is built on ARM at the core. That's the core IP block that everyone is using.
But to the conversation that we were having earlier about whether this is just an effort of Masayoshi Son to distract from some of the other bets that he and SoftBank had made, is that kind of what this was, especially because he avoided pricing this $1 richer, simply because he wanted that 25% pop? He wanted all of the hype around this as a huge success.
Yeah, I mean, look, you want to generate that excitement, and this has been one of his success stories when it comes to, you know, the Vision Fund and just the investments they've made. So clearly, I think an IPO pop is good for the company overall, the sentiment. But I still think anytime you see a company trading at 20 times forward sales, you have to ask yourself, can the growth accelerate from here? And that, I think, is a question mark.
The only question off the Apple product announcement, and I guess maybe we're, to be fair, Lisa, we wait for the Apple earnings announcement whenever that's out in the end of October, I'm guessing, is there's a single headline that comes out of China and everybody goes, oh, all the gloom's wrong. Lisa, there it is. iPhone 15 Pro Max models in China, where you can order the white one with 1 terabyte and have T-Mobile basically pay for all of it. quickly see 4 to 5 week delays. I'm shocked. I'm just shocked.
Yeah, they went on pre-order this morning, and all of the hand wringing around whether people aren't going to buy in China. Well, Apple shares are up about 0.75% on this news as people realize maybe the gloom and doom around China and the demand for iPhones is
Lucy
overstated.
and Charlie Brown in the football. I mean, when are we going to learn, Mandeep?
Yeah, look, I think when it comes to upgrade cycle, I mean, Apple still has a very strong hold. The lock-in is intense.
Can I go geek on this? Can we finish a Nerd Friday?
Please, let's go.
They've got a 3-nanometer chip.
Yes.
The camera's got some new razzle-dazzle. It's titanium, blah, blah, blah. It's got this, it's got that. I mean, like, does Tim Cook know this headline's going to come out 3 days ago?
Well, I think they are very confident in their product cycle, and that's why even if people said on the surface it didn't look like a big upgrade, it turns out
precisely
it is.
Well, hold on a second.
Yeah.
But there's a larger question here, which is, are we getting over our skis and concerns about geopolitical tensions affecting tech demand? That is really at the crux of this, and it goes to ARM and it goes to Apple. Is that what we're seeing today with this headline?
Well, so there is that soft China demand aspect and, the government banning iPhones. So clearly there is a revenue hit there. But the bigger question is the supply chain diversification. Can Apple do that successfully and at the same cost structure that they were doing that over the last 5-10 years?
Although I will say, Tom, that the idea of restricting iPhone use at state-owned enterprises doesn't seem to be dampening demand in China for the iPhone.
Tom Forte. Some guy named Ives at Wedbush.
Yeah, some bull
240
with really cool sneakers.
I mean, it is a debate, but Mandeep, I've been through this like 10 times. OMG is a 4 to 5 week delay for the toy. I mean, we're idiots.
Well, and that's why they raised the prices of the Pro Max, because that's where you see the demand. I mean, clearly there is a market share aspect and then there is an upgrade aspect. The upgrade happens almost seamlessly at the highest end, and that's what you see with the Pro Max.
To all of our team, just thank you so much to you and Anurag Rana for speaking. These guys, I mean, they're like the nerdiest of the nerds. I mean, it's like they're huge. They actually know what's in the phone.
They're huge. That's fantastic. And I
They're
quote
like
you.
huge.
Next time you say that about me.
Where are we on the
Grandma's the
president?
nerdiest of nerds. She's huge.
Lisa, you're our authority. You nailed it last night, 10 p.m. We're UAW. I mean, it's just, to me, it's just going to be extraordinary.
I haven't seen it.
President.
I haven't seen a time yet. This is going to be curious to see how he dovetails, how he tries to thread this needle at a pretty fraught moment.
We're going to thread the needle here to inform you across all of Bloomberg on this strike in Detroit and down to the south as well. 3 automobiles, the Bronco, the Colorado of GM, and the Wrangler. I'm sorry, it's Jeep, not Stellantis. There they are, 3 factories. Our David Weston, with his work and his heritage of living in Detroit. David Weston in conversation with General Motors CEO Mary Barra. Look for that in the 10 o'clock hour. The Weston interview is always a different interview in this time. Not a crisis, but labor tension for the head of GM. Futures -6, Dow futures at -19. The 10-year yield 4.33%. What do you need to know? $94 a barrel, Brent. Good morning.
On the next episode of Hello World, meet the women driving Kyrgyzstan's tech revolution.
This is the first satellite in our country.
And some speedy horses. Watch Hello World Thursdays at 8 p.m. Eastern on Bloomberg Originals or 10 p.m. Eastern on Bloomberg TV.
Could be that given that we have this productivity enhancing technology that is AI, that has come off the back of this transformative communications network that's the internet, and we have a fundamental shift in the way the energy system is working. So there could be the ingredients of a pivot point of a kind that we've only seen a couple of times previously in history.
But let's ask what the driving forces will be. The world is propelled forward and has been for thousands of years by great power competition. That is the thing that drives innovation right now across the board. It is a competition which is intensifying between two superpowers, the United States and a communist-led superpower. Now, is this starting to sound familiar?
It does.
So what is really significant about this historical moment is that we are in the first inning, the early phase of Cold War II.
Right.
And that is going to drive all the things that we've talked about, and it will not necessarily drive these changes in directions that are benign. That the big technological advance of Cold War I was, of course, nuclear weapons. And the arms race with nuclear weapons was an extremely dangerous one that very nearly blew the world up, particularly in 1962, at the time of the Cuban Missile Crisis. I don't believe for a minute that we can have a Cold War II without a similar risk.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg.
Let's get you to the weekend. Live from New York City this morning. Good morning, good morning. Equity futures pulling back just a little bit on the S&P 500. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, UAW hitting Detroit's Big Three with strikes. Automakers conveying their extreme disappointment as we wait to hear from a pro-union president. We begin with the big issue, strikes in America.
We have greater strikes.
News that we're seeing about, the strikes.
The auto workers' strikes. The UAW.
The UPS. The strikes around riders in Hollywood.
Power is still in the hand of a worker.
Labor does have some more power now than it used to.
It's still a very tight labor market.
The labor markets have been tight for 2 years or so.
This could, again, be a weight on the economy and on the labor market.
You're going to have ongoing pressure with wages and inflation.
The risk that we do get that stickiness still in wage growth and inflation.
I'm not necessarily convinced that this is kind of the dying embers of a hot labor market.
Has the labor versus capital pendulum swung for real?
We are starting to reach an inflection point that should put the labor market into a little bit more of a balanced state.
Team coverage starts right now with Bloomberg's Anne-Marie in D.C. alongside Keith Norden in Detroit. Keith, talk to me about how far apart are the Detroit's Big Three and this union?
They are very far apart. On the wage offers, the union has brought theirs down to a request for a 36% wage increase, and GM and Ford are offering a 20% wage increase. So there's a wide gulf.
AMH, the President of the United States, said to address the country later on today. Any idea when and what he's going to say?
We don't have a time yet, Jonathan. That's yet to be determined from the White House. But what we do know is that a month ago, the president put out a statement. He talked about that he wants to see a just transition to a greener economy. What you see this Friday morning is two of the president's key policy goals at loggerheads. One is a move towards electric vehicles. The other is to maintain that he is the most, what he likes to call himself, self-described, most pro-labor union president in history. What you see from a lot from President Biden is that in front of the cameras, he's going to want to have that rhetoric to make sure that he is fighting for labor unions. At the same time, behind the scenes, what you likely are going to be hearing about and leaking from the White House is that they've been on the phones with everyone, the labor union and the companies, to make sure they could try to find an agreement. Jared Bernstein said this week they are encouraging both of these parties to remain at the negotiating table.
Keith, let's talk about strategy. 12,700 workers across 3 plants. They're not going after the Ford F-150s of this world. Talk to me about the strategy and what's left in their back pocket if they want to escalate things.
Well, they certainly have gone after key plants. You're right, they haven't gone after the big pickup truck plants that are the most profitable. But these 3 plants make hot-selling products. The Ford plant makes the Bronco SUV, the Stellantis plant makes the Jeep Wrangler, and the General Motors plant makes the Chevy Colorado, a mid-sized pickup truck, all hot sellers, all profitable. But yes, they've left the door open to ratchet the pressure up even more by going after the big pickup trucks that make the most money for the companies.
Keith, any idea of what kind of number gets this deal done?
You know, there is such a wide, divide between the ask and the offer from the companies. So it's clearly something north of 20%, but the companies say they can only afford so much. They're spending collectively more than $100 billion on their new EV programs. So they say they can't spend 36% or it will bankrupt them.
AMH, just finally, would you expect to see more Democrats on the picket line with these strikers?
Well, Jonathan, I think how Democrats would like to describe themselves if they are pro-union is that they want to be the voice of working people within the government. This is what Seth Harris said to us last night. He was Biden's former aide when it comes to labor unions and helped him coin that term that we continuously hear from the president. But likely you will see some congressmen and women from Michigan that are going to come out and talk on behalf of the UAW. At the same time, Jonathan, you have to remember, elected officials are dealing with constituents that are very concerned about higher inflation. What Anderson Economics says is that this could be a $5.6 billion drop in the bucket of lost profit if it's a 10-day strike. This could mean the difference of Michigan having a soft landing or a recession. This is a key state that Democrats need to keep control of next November.
AMH, great to catch up, as always. Anne-Marie from Washington, Keith Norton over in Detroit. Detroit shaken by strikes on all 3 automakers, GM, Ford, Stellantis. With us around the table here in New York, I'm pleased to say Mohammed Al-Erin of Queen's College, Cambridge. Mohammed, good morning to you.
Good morning, John.
Question that has dominated this program now for weeks, and I'm going to repeat myself once again. Is this the dying embers of a hot labor market, or do you think this is here to stay?
I think this strike is here to stay for a while. Ask yourself 2 questions, a macro question and a micro question. A macro, why did it take so long? When you have a combination of a very tight labor market on the one hand and workers being hit by an unanticipated bout of inflation, you normally get catch-up wage negotiations. But it took much longer here than it took in the UK, for example. So why did it take so long? And then from a micro perspective, if you're a UAW worker, if not now, when? This is your key point of bargaining power. Your bargaining power is going to erode over time. So if you're going to strike, now is the time to strike.
Doesn't this just accelerate the move away from labor in places like Detroit? Is this the last big contract negotiation the likes of UAW are going to have?
So I would put it the other way. It stops the shift from labor to capital, and it provides some opportunity for the shift to come back a little bit. We've had a massive move from labor to capital over the last few decades. And now we're seeing not that stop, and there is a possibility, and I would say there's a desirability in seeing it come back a little bit towards labor.
And a big shift towards labor, potentially, given some of the demands. Any idea of what kind of numbers gets this done? It started at 40, they dropped to 36. Clearly nothing in the low double digits gets it done. What gets it done?
I don't have a feel for it, but it's not just that number. It's also other working conditions. This is an opportunity for the AAW. The big question for all of us, looking at the economy, looking at the markets, will it have demonstration effects? Will it be a catalyst for many more strikes in the US, like we've seen happen in the UK?
Union membership is low in America, so if there is spillover to unions, maybe it could be limited. I'm thinking about the signaling beyond unions. When I see headlines like UBS, when I see headlines like American Airlines, when I see headlines like this, whatever the deal is going to be, it's certainly going to be north of 10% based on what we're hearing. Don't I just go into negotiations at the end of the year, sit down with management and say, you know what, I want some of that?
Yeah, you do. The real question is, do you say, I want some of that, meaning I want to regain some of the wages I lost due to this unanticipated inflation? Or do you also say, I'm anticipating future inflation and I want something more than that? So far, I think it's limited to the first, but if that second one happens, alarm bells would be ringing at the Fed.
Big question for the Fed. Do companies eat this through margins or pass it on?
Depends what happened to the economy. So far, companies have been able to pass it on. The big mistake the Fed made in 2022 is not realizing that companies will quickly pass on what they thought were once and for all and reversible increases in costs. So we're going to see this again. And it's not just labor, it is also energy. So this is another bout. You know, for those of us who lived through the 70s, we remember that there were 2 oil shocks. 2, not 1. So think of this as being potentially a second, much smaller shock. And it'll be interesting to see how it proceeds.
Labour market power on the table, crude in the 90s. If you're at the Federal Reserve next week, what are you thinking about all of this?
So they'll pause. I don't think at this point they can hike, but they'll keep wide open the possibility of another hike, and they're going to push back against this notion that they'll be cutting anytime soon. The message will be, we're going a little bit higher, and we're going to stay there for longer.
Should they worry about $90 crude? If it's just a supply shock, should they worry about that?
They should. I mean, otherwise they're going to repeat the same mistakes they made in 2022.
Which was?
Which was to think that this is isolated, to not realize that there are spillover effects. You know, the big hope, the linear disinflation argument, was goods were disinflating, and in some cases prices were falling, energy. Services were inflating, but if you wait long enough, services will start to disinflate as well. And the fear was that goods would start inflating. Now we're seeing goods are going to start to inflate, and that's, I suspect, will keep people up in Washington, D.C.
I was trying to tee you up to use the word, transitory, the T word. That's the question people are asking now. Is this disinflationary trend of the last few months transitory?
No. Transitory isn't a time concept. It is whether it changes behaviors. Something is transitory if you believe it is temporary, it's reversible, therefore you should look through it. It doesn't change your behavior. When these sorts of news start changing people's behavior, then it's not transitory.
Mohammed, you're going to stick with us more on the Federal Reserve and much more on this energy market move as well. Equities pulling back by about 0.2% on the S&P 500 this morning. With some movers, here's Abby.
John, let's take a look at 2 of the big automakers that are reacting to some degree to this unprecedented strike, by the UAW. We have Ford down 1.8%. GM is also down, not shown, but Stellantis is up 0.5%. So it's interesting to see that the surgical and uncertainty that they're creating by the strategy that they're going after is creating these mixed moves for stocks. Stellantis on the year up more than 30%. Ford is up just about 5% on the year. Adobe down 3.6% this morning. They beat estimates, but their guidance is a little bit light. That stock on the year, John, up more than 60%. Investors wanted perfection from the software maker. They didn't get it. The stock is down.
Abby, thank you. Coming up on this program, energy taking the blame.
Whether it's grain, whether it's oil, whether it's gas, we're looking at all those components very, very carefully because some of them are volatile, some of them are on the way up, and they will have consequences on prices.
That conversation up next.
don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, The product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but expand is expand. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Whether it's grain, whether it's oil, whether it's gas, we're looking at all those components very, very carefully. Some of them are on the way up, and they will have consequences on prices. We had a good scenario analysis produced by staff about China and the role that China growth or deceleration of growth would have on our own GDP and our inflation. That, combined with the price of oil, is obviously something that we need to be attentive to.
ECB President Christine Lagarde highlighting the energy sector, which is quickly becoming the culprit for absolutely everything this week. US retail sales and producer prices coming in hotter than expected, fueled by higher gasoline prices. Auto workers going on strike, the union nervous about President Biden's robust EV transition, eliminating jobs, and a number of US airlines slashing their outlook, all placing the blame on rising fuel costs. All of this no surprise to Jim Bianco, who wrote a few weeks ago, quote, crude oil and gasoline prices are about to take center stage. They take center stage right now. Jim Bianco joined us from Bianco Research alongside Mohammed Al-Arian here in New York. Jim, you said it. Here we are, $94 crude. What does it change?
I think it changes a lot, because while we look at the reduction in supply and we look at the voluntary cuts of OPEC to blame that for the higher prices, let's look over at the demand side. And demand is booming. And demand is booming in oil, and we've got at the same time very weak growth in China. So we're seeing probably a transition from transit commuting to auto commuting, and it's also maybe an underlying sign that there's going to be no soft landing or hard landing in the economy, maybe a no landing because of this continued strength. As long as we have this cocktail of strong growth or strong demand and we have voluntary cutbacks, I think the price of oil is going to keep going up. The price of gasoline is going to keep going up. And the final thing is, I think we're ways away from demand destruction. We're at $3.87 a gallon nationally in the U.S. I don't think it's $4 that's going to start demand destruction. I think it's much, much higher, and that will first foster into much higher inflation before we start talking about demand destruction.
Hey, Jim, this is really important. This goes back to one of my favorite questions at the moment. Do you view this, then, as a reflection of the extension of the cycle and not a recipe to end it?
Yes, I do view it as an extension of the cycle. I've always been of the opinion that we're in a post-pandemic economy. Big fancy word for meaning that shutdown restart of the economy in 2020 was the most important economic event of our lifetime. When we rebooted the economy, it did not come back the same. That doesn't mean dystopian or worse. It means different. And we've got this chronic shortage glut cycle as we try to figure out what this post-pandemic economy means. And this is more of the same, whether it's the China slowdown, it's the gasoline, or it's even the strike with the UAW and the Hollywood strike and nearly the strike with the freight trains and the West Coast ports, and all of a sudden the movement and labor that we've seen. It's all part of that same mosaic that the economy has fundamentally changed since 2020. Not worse, changed, and we still haven't quite figured out what that is.
Jim, you put forward two hypotheses. One is that oil and gas prices are going higher, and two is that demand destruction will take time, which raises a very important question. What's your feeling about the pass-through? How much of this is going to spill over into a wider price impact?
I think it's going to spill over into a wider impact. I think that the attitudes have changed. I wouldn't quite go as far to say that, inflation expectations are unanchored, but let's say they're loosening as we move forward. I'll remind us back in 2021, when Procter & Gamble raised prices, they announced it in March. They said it would take place in September, and they said that in the interim, they'd write a white paper to explain why they were raising prices. That's how epic it was to raise prices 2 years ago. Today, we just raised prices. And so we've loosened the anchor a little bit. And I think if oil prices keep coming up with that loosening anchor, we're going to see this getting passed through, not just at the pump, but in transportation costs, delivery costs, input costs. It's going to be problematic, I think, up and down the line.
So if you are sitting at the Federal Reserve and you agree with your three hypotheses, oil going higher, no demand destruction, and it will be passed on, what would you do?
Well, I've been a bit more hawkish than the consensus. I think that they're going to raise rates in November, and I don't think that that's going to be the last rate hike. Now, the next one might not come until 24, but even if there isn't another rate hike, I think the idea that there will be multiple rate cuts in 2024 is premature. The only reason the Fed would cut rates in 24, I think, is if we saw a recession, a full-blown out hard landing recession, and they responded to it. Short of that, I'm in the higher for longer camp, and I'm not even sure that one more rate hike is really done, and that's the way I'd be looking at it.
So, Jim, you've got to make a bond market call off the back of that analysis. We've got a 10-year in the 430s, a 30-year around 440, a 2-year still in and around 5% right now, up 2 basis points on the day. What's the bond market call?
I think the yields are going to continue to head higher. I don't think that the cycle is over. Well, let me back up and say that yields bottomed in August of 2020. I think that ended the 40-year bull market in bonds. We're in a multi-year bear market in bonds. We're in year 4. August of 23 started year 4 of it. We're only 3 basis points or 4 basis points in the 10-year from another 16-year high. And I think that those rates were going to continue higher. Now, there will be fits and starts. There will be rallies. There was a huge rally in the bond market off of the Silicon Valley Bank failures in March. But then we turned around and completely reversed that by the end of the summer. And so I do think that irregularly rates are going to go higher. I think irregularly that the yield curve is going to at least stay at its current space or maybe even flatten or get more inverted, because ultimately I don't think the Fed is done with one more rate hike. So I'd have a very defensive position in the bond market right now regarding rates.
Jim, if that's the call and if you're right, where's the rest of the world? Where's Europe? Where's China?
Well, I think that there's a little bit of a split between China and the rest of the world. If I'm right, and the problem is that we've got sticky inflation and a post-pandemic economy. That's global, and that's going to impact everybody else. And we're seeing that whether you're talking about Japan or Europe, higher inflation across the board everywhere. We're seeing higher rates across the board everywhere, and I think we're going to continue to see those rates moving higher. China's a little different story. They're on a different cycle. They're decelerating. They're going down in terms of their economy, and I might add, it's really surprising that after they opened from zero COVID at the beginning of the year, their economy just kind of was a dull thud on the floor in terms of its pickup. So that might be something different. And because they're in a different cycle, I don't think that the spillover effects from China, there will be some, won't be nearly as great as people fear. So I think globally we're going to continue to see higher rates as well in an irregular pattern, but they're going to keep going up.
Hey, Jim, fascinating call. Jim Bianco there of Bianco Research. The last 24 hours has been so busy. China cut the reserve requirement ratio, and we barely talked about it. Mohammed, quite a call there from Jim. The idea that this is going to stay, that the data is going to continue to surprise into the upside. We had industrial production out just moments ago. That came in hotter than expected at 0.4%, the estimate 0.1. Do you get the sense that this economy still is more resilient than people are giving it credit for?
I do. I think the U.S. exceptionalism when it comes to economic activity has been remarkable, and it's going to stay for a while. There is a lot going on that is good in this economy. Now, we could hit a pothole. There's no doubt about that. Jim pointed to one possibility, which comes from the energy prices. Another possibility is a government shutdown. A third possibility is the Fed making a policy mistake. But left to its own devices, this economy still has momentum.
Jim's not alone. Others are out there saying the same thing. Bill Dudley, the former president of the New York Fed, a guy who you know well. Remember that conference we did together back in the summer of 2021, and you were both saying this inflation story is real? He was talking up 5% interest rates at the Federal Reserve. He's now asking the question as to whether we've already seen all of the lags from policy. They're done. They hit the economy, we're moving on and accelerating again. Where are you on that?
So there are so many uncertainties about monetary policy right now. You know, Chair Powell said at the end of his Jackson Hole speech something along the lines of, we are looking at the stars, we are guided by the stars in a cloudy sky. I think that was the phrase. Well, if you look at the stars, they're all moving. No one knows where our star is. No one actually knows what the right inflation target is, and no one knows what the right monetary policy framework is. And then if you look at the clouds, there's massive disagreement on, have we seen the last of the lagged effects, or are they still to come? There's massive disagreement on what will QT do on top of all this, and people disagree on whether it's the level or the change in rate that is in the driving seat right now. So there are so many uncertainties. I listened to Bill Dudley really carefully.
Yep.
The major pushback against Jim's view and Bill's view are those who believe in technicals. Those that believe that there's a ton of money waiting at the short end of the curve and looking to extend once we get to 435, 440 on a 10.
Mohammed, stick with us. Coming up, the morning calls, and later, SIBO's Mandy Zhu joined us at the opening bell as stocks look to rebound from last week's declines. From New York, this is Bloomberg.
Maybe I should go do something else. I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Equities a touch negative. Let's get you some morning calls. First up, Piper Sandler upgrading KeyCorp to overweight, highlighting the stock's compelling valuation and easing funding concerns. Your second call comes from Moffett-Nathanson, downgrading DoorDash to market perform, expecting the resumption of student loan repayments to weigh on future bookings. And your third and final call from Redburn, upgrading Estee Lauder to neutral, seeing limited downside and strengthening fundamentals. Up next, SIBO's Mandy Zhu joined us at the opening bell and why the fear gauge is trading near 2020 lows. The opening bell, up next.
crucially important. And I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
On the next episode of Hello World, meet the women driving Kyrgyzstan's tech revolution.
This is the first satellite in our country.
And some speedy horses. Watch Hello World Thursdays at 8 p.m. Eastern on Bloomberg Originals or 10 p.m. Eastern on Bloomberg TV.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise?
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
Seconds away from the opening bound this morning. Good morning to you all. Heading towards a week of gains on the S&P, pulling back just a touch on futures, down about 0.4%. On the Nasdaq, a similar move. The big story in Detroit, a strike on all three: GM, Stellantis, Ford. Those three names doing okay in the pre-market. We'll talk about how they perform coming out the other side. There's your opening bound. Switch on the board and get to the bond market. Yields look like this on a 10-year, high by a couple of basis points at 430.65. In foreign exchange, the dollar stronger, potentially for a 9th consecutive week against the euro, a record weekly run. This morning, the euro just a touch stronger by 0.2% at 106.65. And crude had a little look at 90, then pulled back. WTI, 89.35 and negative 0.9%. About 25 seconds into the session, we're down 1/3 of 1% on the S&P. On the Nasdaq, we're down 1/3 of 1% also. One sector to watch at the open: the automakers, GM and Ford, under pressure as the United Auto Workers start striking at select locations. UAW President Shawn Fain saying this strategy will keep the companies guessing, and if we need to go all out, we will. Abby has more. Hey, Abby.
Hey, John, it does seem that confusion and uncertainty are one of the biggest goals of the UAW in terms of this strike strategy. Some experts saying that it is probably one of the least painful ways that they could stage a strike against the big three automakers, although, of course, it is unprecedented in the fact that they are striking against all three at the same time. Now, on Friday, today, at midnight, workers walked out of the three plants, one from each of the big three companies in Missouri, Michigan, and Ohio. It's being called a stand-up strike, and this is the strategy of the UAW, that they can call up other members of the UAW to stand up at every time and create logistical, surgical, tactical problems for these automakers. Right now, it's less than 10% of the UAW's 145,000 members that have walked out, and again, to create the uncertainty for the big three. But for the stocks, John, there's not so much uncertainty. I would argue GM down 0.6% and Ford down 1.4%. It could be much worse if investors were really nervous. Now, that said, each of these stocks, including Stellantis, down between 10 to 20% from the July peak. So some of this is priced in. We've been talking about this for a while. And although the gap between the UAW and the automakers for a pay raise is wide, 20% to 36%, some are saying the fact that the UAW hasn't gone for the jugular, it may mean that there could be some sort of a deal in the works.
Abby, thank you. Let's see if we can close that deal sooner rather than later. Tesla might be loving what we're hearing. Dan Ives of Wedbush expecting one automaker in particular to benefit from the work stoppage, writing this: the clear winner in this Game of Thrones battle between the UAW versus the big three is Musk and Tesla, with Champagne now on ice, which sits in a non-union position, and its biggest potential EV competitors now face mounting costs and complexities in the years ahead, depending on how this ultimately plays out. Tesla this morning, positive through much of the day. Turning to the media space, Disney is said to have had initial talks to sell its ABC network and other stations, the company writing in a statement, "While we're open to considering a variety of strategic options at this time, we have made no decision with respect to ABC or any other property." Simone Foxman has this one. Hey, Simone.
Yeah, it's not just Nexstar, also potentially Byron Allen, who Bloomberg has reported, and we've been all over this story, has offered $10 billion for ABC TV network, local stations, as well as FX and National Geographic. While the company might not have made any decisions, though, analysts are already trying to pick through exactly what this would mean, both for Disney and its potential acquirers. The commentary pretty mixed. Bloomberg Intelligence estimating that selling ABC and the local networks could potentially bring Disney $4 billion. Rosenblatt Securities believes this could be great for breakup value argument for Disney's equity, but it would be risky for Nexstar, whose shares rallied yesterday. KeyBank, however, saying that selling ABC would be negative for Disney because it would likely be done on a highly dilutive basis. And the interest in selling implies that Disney soon thinks pay TV will implode. The assets on the block, the idea, not completely surprising. This is something that CEO Bob Iger had hinted about back in July. But with Disney closing at its lowest since 2014 on September 7th, we're seeing some positivity in the shares today as everyone reacts to this news, John.
Simone, thank you. Let's turn to the semis just briefly. ARM seeing a successful day, first day of trading, jumping nearly 25% in that debut. Needham initiating coverage on shares with a neutral rating and writing this. ARM can grow by capturing greater value from smartphones, but not enough support upside from the stock's IPO valuation. Shonali Basak following this one. Hey, Shonali.
John, you might have heard about it. It's the AI frenzy, and you have ARM feeling the heat of it. Remember, when you look at Thursday, retail orders into Fidelity surpassed 20,000 orders for ARM. So you do have retail investors and institutions alike pouring into the stock. And today, when you look at it, have a second day of trading higher, you could say something today that you couldn't say yesterday, which is that ARM is finally valued above where SoftBank repurchased its stake for just a couple of weeks ago. That was at $64 billion, now it's closer to $70 billion. But now its valuation alone is on the list rather, of the risks that ARM faces ahead. That includes its nearly fourth of its sales tied to China and the risks tied to geopolitical risks in the chip wars, as well as declining smartphone sales, as well as profit alone, even at ARM facing pressures in the most recent fiscal year. Those are the list of risks that these investors face ahead. But today, yesterday, and into next week, as we face a whole horde of IPOs ahead of us, this so far is not an issue.
Shonali, thank you. The stock up again by 3.8%. Turning to Adobe, the software company delivered a mild sales forecast despite the optimism in AI. The CEO saying this: "We are unleashing a new era of AI-enhanced creativity around the world with innovations across our product portfolio." Isabel Lee on top of this one. Hey, Isabel.
Hey, John. So just like a lot of other companies, Adobe has been getting a lot of mileage out of AI, but over-optimistic investors are just wanting for more, which is why even if sales forecasts meet expectations, we see shares slumping to around 5%. So here are some numbers. Sales will be $4.98 to $5.03 billion in the period ending November. Analysts were expecting around $5 billion on average. Profit excluding some items will be as much as $4.15. So that's 9 cents higher than estimates. So Adobe is adding generative AI to a lot of its products, and they will be increasing those products beginning November. And analysts expect this new increase to lift revenue quickly. We have William Blair expecting that it will add around $600 million over the next year, and Bloomberg Intelligence projects a 10% sales increase in the first year. But of course, there's a flip side for everything. Some express caution that the price increase would affect demand, John. But for now, Adobe has rallied some 60% year to date.
It's just down this morning by 4%. Isabel, thank you. Joining us now to discuss this market, Mandy Zhu of SIBO Global Markets alongside Mohammed Al-Arian. Mandy, let's get straight to it. The VIX, you know the complaints. Has it become totally irrelevant?
We don't think so. I mean, I think the decline in the VIX obviously has puzzled a lot of investors this year, but I would say it's really a reflection of the change in the macro environment, right? So when we started this year, the consensus among economists, among investors was very much, recession risk in the US. And now as we stand here, 9 months later, the consensus has turned into a soft landing. And that's why the decline in volatility has really been across asset classes. We're seeing it in FX, we're seeing it in rates, we're seeing it in commodities, in credit. It's really in line and in sync with the other asset classes, which suggests to me that it's very much macro-driven rather than anything equity-specific.
That's your observation. Let's get your judgment. Do you think those soft landing hopes and dreams are relevant? Do you share them?
Look, I mean, there's clearly still a lot of risks, going forward. And I think that's why we starting to see a pickup in option volumes in VIX, particularly investors coming in to buy those VIX upside calls and call spreads. VIX option volumes are actually on pace to hit a record this year, which I think surprises a lot of people given, the market rally. And I've gotten a lot of questions around kind of why the interest in hedging now versus last year when the market was actually selling off. And I do think a big part of it is positioning, right? People have capitulated to the soft landing view. We're seeing leverage really start to build. Institutional investors really start to increase their allocation to equities, systematic strategies increasing their allocation as well. So as leverage builds, that's when you could potentially get, that convex move in volatility. And I think that is driving a lot of that interest in this VIX upside calls.
So, Mandy, we're looking at two worlds. One where things are relatively calm, you just described it, and it's reflected in the VIX. Another one, whether it's in rates or in FX, where people are seeing major relative price changes. John mentioned dollar stronger 9 weeks in a row. We've seen what has happened to U.S. rates relative to the rest of the world. Can we live in this two-world world, or at some point do we see convergence? And what does that convergence look like?
That's a great question. Can we live in this world? We've been living in this world for about 2 years now, where we've had elevated rates of volatility and relatively more subdued equity volatility. And what I would say is, that divergence is only a mispricing if you think the volatilities in each of these asset classes reflect the same risk. And I would argue they actually do not, right? Rates volatility is really a function of policy outlook uncertainty. And as we stand today, there's still a lot of uncertainty of whether ultimately terminal rates going to end up, right? Could we see rates, Fed taking rates above 5%, 6%? Yes, absolutely. Could they, be cutting rates if economic situation turns? Absolutely. But I think for equities and for a lot of risky assets, what really drives volatility in those asset classes is the risk of recession. And that has undeniably gone down over the past year as we have seen, labor market data hold up and inflation come down. So I think that's what is driving it. And then specifically with the VIX, I would just say, given that it's a 30-day measure of implied volatility in the S&P, it's much more catalyst-driven rather than a gauge for long-term recession risk.
I'm pleased you mentioned that number 30. I want to talk about this one, 0. Mandy, just briefly, 0-day to expiry options. We've had a long conversation about that over the last 12, 18 months. Mandy, there's a lot of volume there, an explosion in volume coming out of the pandemic. From your perspective, does high volume equal high risk?
No, it does not. And I think that's the source of the misunderstanding in this product, right? So yes, 50% of option volumes in S&P is going through these 0-day to expiry options. So people often quote the notional number, 500 billion a day trade in these 0 DTE products. But what matters at the end of the day is the net balance between buys versus sells. If everyone is chasing, one side of the trade, then potentially, yes, that could pose risk. But if the flow is evenly split between buys versus sells, then at the end of the day, the net risk to market makers hedging those positions, it's very minimal. And what we see, and again, at SIBO, we see all this flow, right? All these options trade on our exchange. And what we see is that the flow is remarkably close to 50-50. And that at the end of the day, the net risk to market makers having to hedge those options, we're talking about 0.1% of the S&P daily liquidity. So this is not a case of the tail wagging the dog at all.
Mandy, appreciate the update. Mandy Zhu there of SIBO. Mohammed, let's talk about this market more broadly. You remember the days when we had 0 rates, we had QE forever, and people would come on programs like this one and say, we can't possibly go back to 5%. This is what the market is built on now. I take Europe as an example. I never thought we'd go to 4%. over the ECB. I thought it was a potential in the pandemic that we'd never see a rate hike from this ECB for the next cycle, never mind the last one. And here we are. Do you think we can adjust and have adjusted to these high rates?
So far we've adjusted remarkably well. Remember, it's a trilemma. How do you reduce inflation without pushing the economy into recession and without causing excessive financial volatility? And so far, in the US, we have achieved all three. So far, so good. However, remember, especially if rates stay higher for longer, there are things that have to be refinanced in this economy that cannot be refinanced in an orderly fashion at these rates. So this is not something that happens instantaneously. It's something that happens over time. Now, in the UK, because the mortgage market has such short duration, it happens very quickly. Here, it happens more slowly. And that's why the long bit of higher for longer is really important. How long is longer?
So the effective rate on mortgages right now in this country is 3.6%. Torsten's Lock of Apollo put out some work over the weekend, and I'm sure you're familiar with it. Ultimately, at origination, I think about 10% of the mortgage market is paying above 6%, so we're just not there yet. And to your point, because it's 30 years, it could take a long, long time. I'm thinking more specifically about high yield. Is there a spot on the calendar where corporations below a certain grade are going to come to market and they're going to have some problems?
Yes. I mean, if you look at high yield, if you look at commercial real estate, massive refinancing needs next year. Massive. So that's the point of pain that starts to happen. Now, some people will tell you there's lots of distressed credit funds with lots of money waiting to come in. And we're going to see a game of chicken between the two. That's what we're going to see.
Is that the story for next year or the year after?
I think it's a story for next year. And we've got to be really careful. That's why the minute the market starts pushing back rate cuts, and it hasn't really pushed it back, but the minute it starts pushing back rate cuts, the conversation gets a lot more interested in various segments.
And more data like the data we've had this week, and maybe we go in that direction. Mohammed, stick with us. Coming up, looking ahead to a Fed rate decision.
I think they'll be inclined to deliver a hawkish pause. If you look at the underlying trends, core inflation is moving in the direction they want. So I think what we'll see next week is a pause, but an indication that they're prepared to do more.
Chair Powell taking center stage in a busy week for monetary policy. That conversation up next.
What do you have for skincare for men in their 70s that have a lot of wrinkles? I mean, is there any way to get rid of the wrinkles?
I have a lot of amazing things,
Really?
but maybe it'll be a little bit beyond skincare.
Could be that given that we have this productivity enhancing technology that is AI, that has come off the back of this transformative communications network that's the internet, and we have a fundamental shift in the way the energy system is working, so there could be the ingredients of a pivot point of a kind that we've only seen a couple of times previously in history.
But let's ask what the driving forces will be. The world is propelled forward and has been for thousands of years by great power competition. That is the thing that drives innovation right now across the board. It is a competition which is intensifying between two superpowers, the United States and a communist-led superpower. Now, is this starting to sound familiar?
It does.
So what is really significant about this historical moment is that we are in the first inning, the early phase of Cold War II.
Right.
And that is going to drive all the things that we've talked about, and it will not necessarily drive these changes in directions that are benign. That the big technology technological advance of Cold War I was, of course, nuclear weapons. And the arms race with nuclear weapons was an extremely dangerous one that very nearly blew the world up, particularly in 1962, at the time of the Cuban Missile Crisis. I don't believe for a minute that we can have a Cold War II without a similar risk.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
I think they'll be inclined to deliver a hawkish pause. They have gotten good news on inflation. Yesterday, a mixed report, but if you look at the underlying trends, core inflation is moving in the direction they want. So I think what we'll see next week is a pause, but an indication that they're prepared to do more. And I would expect them, I think it's finally balanced, but I would expect them probably to get one more hike in this cycle.
Former Fed Vice Chair Richard Clarida on the Fed's next move. The September FOMC meeting kicking off next Tuesday, leading a busy week ahead for policymakers with rate decisions coming from the Bank of England and the Bank of Japan. Mike McKee has more. Morning, Mike.
Morning, John. We're all traveling next week. I get to go to Washington. You get to go check on the Bank of England. Maybe we should meet in Tokyo when we're all done, because it is a big week with three central banks who have the same problem, inflation, and the Japanese have actually joined that party. Take a look at the inflation rates in all of these countries. You can see the Bank of England's problem. They have a very large inflation problem. The U.S. has made a lot of progress, but we just ticked up a bit. So does the Fed raise rates? The betting is they probably will. And the Japanese are now above zero and have been there long enough, and the odds are they're going to keep inflation high according to the latest forecast. So they may start tightening policy a little bit as well. Which leads us to what's going to happen in the markets. Well, the bet is nothing from the Fed, even though Rich Clarida was suggesting a hawkish pause. Nobody thinks they're actually going to hawk out and raise rates, about a 3.8% chance, as you can see. There is a bet, a strong bet on the Bank of England moving, and now there's a bet on the Bank of Japan. We haven't had that in a very long time. What do all three of these have in common? The U.S. dollar. The dollar has been strengthening because the Fed keeps raising interest rates, and because the U.S. is the biggest economy in the world, it's affecting everybody else. You can see the impact on the pound, and you can see the impact on the yen. I reversed the yen so you could get an impression of what it's actually doing. It's getting weaker, and that's a question for the Fed. Do they care? They care. They don't want to hurt other people, but their job is the United States. So expect the dollar to stay strong for now, and it's going to have an impact on the rest of the world. I guess you have somebody sitting with you who has a pretty good handle on cross-currency issues for people who work in two parts of the world.
That's a question for Mohammed, Mike McKee. Mohammed, have we got a dollar problem for all these central banks?
So in the past, whenever we've seen a very sharp appreciation of the dollar, it has tended to break something. What I thought was really interesting from Mike's comments is the Bank of Japan. I don't think the potential for the Fed to surprise is very large. It will keep rates unchanged, nor do I think the potential for the Bank of England to surprise is very large. It will raise 25 basis points. The big uncertainty is the Bank of Japan. And that is what I think markets haven't understood. It's not as much rates as the yield curve control. Do we get another signal that they are easing out of yield curve control territory?
Well, where do you think they are now? What is the actual policy on yield curve control of the BOJ?
So they're tolerating a 70 basis point 10-year, which was unthinkable 6 months ago. And I think they may indicate that they're willing to tolerate something more, and the rate will move immediately on that news.
Governor Wade has suggested that maybe they do raise interest rates at the end of this year and abandon negative interest rate policy. Do you think we should be paying attention to that as well?
We should absolutely be paying attention, not because of the rate spillover, but because the Japanese are very big owners of foreign securities.
Okay, so the next question is, what does that mean for treasuries? So the anchors have gone now. Put the market away. ECB is done with all of this. Bank of Japan said to follow potentially, given what you've just said. Does that mean a new floor for treasuries or a new ceiling for treasury yields?
So first, the policy anchors have gone away. Okay, the economic anchor is still holding in the US. That's really important. It's important for the US, it's important for the rest of the world. And then there are the technicals. The good news for most market participants is that the technicals are favorable. Keep a very close eye on the 10-year if it gets to 0.35, 4.35. That is a major resistance point. And if it goes through there, then people are going to start talking about 450, 475, and it's going to be a different narrative.
Interesting. 433 right now, by the way, on a 10-year treasury. Mohammed, stick with us. Coming up on the program, I'll run you through the trading diary, the calendar for the week ahead. From New York, this is Bloomberg.
Most of the large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we've seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Let's get to the calendar. The week ahead looks like this. At the top of the hour, UMich Consumer Sentiment Survey Plus. President Biden expected to address the UAW strike later today. Wednesday, Fed rate decision, Pound News Conference. Thursday, the Bank of England's turn. And finally, on Friday, it's the BOJ. Mohammed with us around a table in New York. Mohammed, what a week.
What a week, and next week will be also what a week.
What stands out for you this week?
4 things: U.S. growth exceptionalism. 2, the return of some inflationary pressure. 3, Europe deep into stagflationary risk. And finally, Japan likely to exit YCC much quicker than most people expect. That is quite a combination for 1 week.
Stagflation, risk or reality in Europe?
I fear it's going to be a reality. I really worry about that, John.
That is brutal. It just looked terrible for them this week, didn't it? What's the answer? What's the policy response you should have when you confront that into next year?
So I know what the ECB is going to do. It's going to stick to its single mandate. I think policymakers have to do a lot more on the industrial policy side because they have to take advantage of this opening as a transition in their growth model, something that's absolutely critical.
Interesting. Mohammed, just fantastic to see you, as always. Thanks for being with us. Mohammed Al-Arian from New York City. That does it for me. Have a fantastic weekend. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
don't think we can replicate Tesla. Tesla is a unique because when they founded, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
All right, good Friday morning from the Bloomberg Interactive Broker Studio. Matt Miller and Paul Sweeney live here speaking to you with the markets report. Coming up in just moments, David Weston, Bloomberg Television, will be sitting down with Mary Barra, the CEO of General Motors. We'll bring that to you in just moments. But first, let's go to John Tucker for a Bloomberg Business Flash.
All right, stocks open lower. Investors assessing a gauge of manufacturing activity in New York State indicated a rebound this month. Right now, the S&P 500, 19 points lower. Dow Jones Industrial Average down 36, and in the early going, the NASDAQ 100 right now 143 points lower. Matt and Paul.
All right, John Tucker, thank you so much. We appreciate that. So that's going to be an interesting discussion here, Matt, coming up in just moments. David Weston with Mary Barra. Day one of the strike. This is both sides seem pretty entrenched here.
Yeah, absolutely. And I don't know if there's a right answer, because if they get everything that they want, the pay rise, okay, maybe, but the pension, defined benefits pension, more difficult. A 4-day work week, maybe too difficult.
Yeah, 4-day work week, that kind of jumps out at you here. But again, you know, they can make the argument they gave up, they made a lot of concessions here to get these automakers back on their feet after the great financial crisis, and then inflation just exploded for everybody out there.
Well, and people like the CEO, Mary Barra's pay went from $5 million in 2012 to $30 million now.
All right, here's David Weston right now with CEO Mary Barra of General Motors.
For our Bloomberg television and radio audiences worldwide, I'm David Weston. We're welcome now Mary Barra. She is the General Motors Chair and CEO. So, Mary, you are the woman of the hour, I must say, whether you like it or not. Let me ask the question I think on everyone's mind. What comes next? We know there's individual plants that have been struck at all three of the big automakers in Detroit. How far away are we from layoffs as other plants really run out of the parts?
Well, you know, David, first I want to say I'm extremely disappointed and frustrated that we're even on a strike. We didn't need to get here. General Motors has an exceptionally strong offer on the table. It's historic. It's the largest increase from a wages perspective in our 115-year history, along with world-class health care benefits and many other provisions, job security, et cetera, and a COLA adjustment. So when you look at the strength of the agreement we have on the table, you know, we really don't need to be here. Yes, they have one plant down right now, and you know, it'll impact three very important products. Two brand new, our Chevrolet Colorado and our GMC Canyon, both mid-size pickups that are are in strong demand, as well as our Chevrolet cargo van that does exceptionally well in the market. So this is having an impact, and we'll have to see where they go next. I will say we're ready for this. You know, as we've dealt with COVID and dealt with the semiconductor shortage, as well as other supply chain challenges that have, continued to persist from COVID. Our team knows how to manage these situations. They're staying agile, and we're going to do what's right for the company. We're going to make sure everyone stays safe. But this is a strike that didn't need to happen.
Mary, as you say, you've made an offer already for a rather substantial increase in wages. It's not what the UAW wants. Implicitly, you've agreed that they do need and deserve some increase in wages. But is this about more than that? Is this existential in a sense for the auto companies in terms of your need to move into electric vehicles, and from the UAW's point of view, that they believe that, in fact, moving to EVs will actually cut the workforce by as much as 40%?
Well, you're absolutely right. This is a once-in-a-century transformation we're in the middle of moving from internal combustion engine vehicles to electric vehicles. And at GM, we're at a very pivotal point because we have so many electric vehicles ready to launch, in the process of launching. And this is important to securing all of our futures. We need to get these vehicles out. They're wonderful vehicles. We've got waiting lists for most of them, or orders already in place. So it's important that we meet that demand. And one thing from a General Motors perspective, from job security, we have jobs for all of our people as we make this transformation. More than 2 years ago, we started planning for this. And one of the reasons General Motors invested in doing our own power units, which is a component that's very important on an electric vehicle, we designed them internally, and we are now allocating that production to the plants that build internal combustion vehicle engines right now. So we have worked very carefully to have a job for everyone so we can make this transformation together. And frankly, when you put have a strike and we're not making vehicles, you start to put that at risk. So it's a historic transformation. We need to make sure we can compete, and we need the company to be profitable because those profits get invested in new products that, again, it's a circle of when we invest in a new product, there's demand for that product from consumers that provides the jobs because we're building those vehicles in our plants. We need to invest in our future, and we have a plan to take all of our employees along. I think this is very important. So that concern there's not a place for them is not true at General Motors.
If, Mary, you were to find it in your heart to come close to what they demand, to accept it, what would it mean for the future of General Motors? You've just come out of bankruptcy 15 years ago, as I recall.
I think that's a very important point, because if we can't invest in new vehicles, which we need to be profitable to do that, then we're not going to have a strong future. And David, you know extremely well, this is a very competitive industry. There's new entrants that are not represented by the UAW that already had a lower, wage structure. So we need to compete. I'm really proud of our manufacturing team. The way they managed through COVID, the way that they have worked and been very agile as we've dealt with all the supply chain shortages, and the fact that for the last 2 years, between our engineering and our manufacturing teams, they've delivered world-class quality as recognized by J.D. Powers. We have a strong team. We want to do everything in our power to win the future, secure their future, and lead for the next 115 years. We need to be able to do that.
Mary, are the negotiating teams meeting today, to the best of your knowledge? And by the way, are you participating directly in any way?
I have been participating. I've been involved since before July 18th, when the talks kicked off. I've been on call more than once a day, calls, texts, meetings, and I have been at the main table myself over the last few days. I'll continue to be extremely involved. Our team's ready. They're there waiting to negotiate. So, my request is the UAW leadership needs to get back to the table so we can get these problems solved, get our people back to work. I think another important point is, for every job that General Motors has, there's 6 more jobs in the economy that depend on us running. So this is broader than just General Motors. This is important for the plant cities, especially, but really for the nation.
Yeah, we talk about 150,000, potentially it's a lot more than that, to your point there. Lastly, Mary, I'm mindful of the fact that your father was a tool and die maker at Pontiac, when my father was a tool and die maker at AC Sparkplug, just some 30 miles apart. You and I, and as young people, have gone through UAW strikes, different from this one, but we've gone through them. What do you think our fathers, if they were with us today, what do you think they'd say to each other about what we're seeing right now?
Well, I think my father would say, as he looked at the historic deal that we put on the table, that the company is committed and wants to recognize our employees for their hard work and wants to make sure they have a secure future. So I think he would look at this offer, and if it was on the table for him to vote, he'd vote yes.
Okay, Mary, thank you so much for your time. As I say, on a very, very busy day for you. I really appreciate it. That's Mary Barra. She's General Motors Chair and CEO.
All right, that was Bloomberg's own David Weston in discussions with Mary Barra, the CEO of General Motors. And again, not surprisingly, Matt, Mary Barra says, hey, we put a competitive bid on the table, a competitive offer on the table, and she implores the labor leaders to come to the table and negotiate.
Absolutely. I'm interested to see what the President of the United States of America has to say. I mean, he has said, Joe Biden, that he is the most pro-union president in the history of this country. So I guess that means he's going to support the union in this, but I'm just not sure he can afford to do that, because if he does and the strike goes on, it could cause a real problem for the U.S. economy.
Yep, the ripple effects are huge. We had some economic data coming out today from that school that has a phenomenal football program, that being the University of Michigan. A couple of things jump out at me. I mean, the UMich sentiment came in a little bit weaker than expected, lower than last period at 67.7.
Still
the
high.
Expectation was 69. But the inflation outlooks really kind of got to me here. Much better than we had seen in the past. The one-year inflation outlook, 3.1%, was the actual consensus was 3.5%, which what it was last period. So down markedly on a one-year basis, and even on a 5 to 10-year inflation outlook basis, the number came in at 2.7%, markedly lower than the 3% of last period, and 3% consensus.
Yeah.
So that's interesting.
Yeah, I totally agree. You have a miss on sentiment. You have a bigger miss on current conditions, but inflation expectations are, I think, much lower, substantially lower, let's say, than we had been expecting, and substantially lower than the previous readings. So it looks like consumers are not that unhappy about the current economic situation and are optimistic that inflation is going to come down more quickly to the Fed's 2% target.
Yep. So very interesting stuff coming out of Ann Arbor, Michigan, University of Michigan. All right, let's follow up on that discussion that we just heard between David Weston and Mary Barra with Liam Denning. Liam's a columnist for Bloomberg Opinion. He's got a great column out today, which I read. Striking auto workers can't bring back the 1950s. Liam, what did you mean by that in your column today?
Well, I was really talking about some of the demands that the UAW has been making on the auto workers. And I think I'd separate it into two piles. I think there is a wide but bridgeable gap on the pay issue, simply because, really all the UAW is asking for there is clawing back some of the wages they lost to inflation after the pandemic. And during that period, coincidentally, the auto companies, North American businesses, did very well. I think where they're being unrealistic is things like restoring what I would call kind of the pre-2007 settlement, things like defined benefit pensions, healthcare for retirees, a shorter work week, that sort of thing. Detroit just isn't what it was back in the day. And agreeing to those things, I think, would just present, too high of a burden on the profitability of the companies.
And Liam, we've also got the realization that this is an industry going through a tremendous, a generational, once in 100 years transformation to electric vehicles. And that, on its surface, does not bode well for the workers, because, the consensus is maybe 30% fewer workers per vehicle, something along those lines. Boy, that's got to be an issue that has to be addressed somehow.
Yeah, there is, to be honest, there's kind of an unresolvable tension in the Biden administration's approach here, which is obviously they want to make green technology cheap so that Americans will buy it, but they also want that green technology made at home, which is going to raise prices because, let's face it, the only reason it's even feasible to talk about an energy transition is that the cost of things like batteries has come down spectacularly, largely because, China decided strategically to build that industry through subsidies and cheap labor, and bringing that or reshoring that to the US is inevitably going to raise costs. So that's a problem for the administration's targets here. It's a problem also for the legacy car companies because they have to balance, winding down a profitable legacy business while investing money in these EV businesses that aren't terribly profitable right now. But it is, as you say, a real problem for the union because EVs just are simpler mousetraps. They don't need the transmission and drive trains that account for about half the current factory footprint. And, judging by what we're seeing at the industry leader, Tesla, as it develops its next cheaper model, the drive here is to basically automate and simplify the manufacturing process as much as possible. So I think as much as the UAW probably will win pay concessions this time around, its bigger task over the decade and beyond is actually trying to protect jobs.
How much of a disadvantage is union labor a disadvantage, I guess, is a better question, Liam, because as far as I understand it, workers putting cars together for GM, Ford, and Chrysler cost a lot more than workers putting together BMWs in Spartanburg or Hondas in Marysville or Teslas in Fremont. What's that delta? What's that gap?
The estimates that I've seen is that the all-in cost for a UAW worker is roughly around the kind of $70 per hour mark versus, say, at a factory in a right-to-work state, you're probably looking at more like $50. So that is a meaningful delta. Having said that...
Well, that's now, right? What if they get the increases that they want?
Sure, yeah, that's now. Now, having said that, for the big three, the current wage bill for the UAW, back of the envelope is about 4% of revenue. Now, if you bump that up a bit, then sure, you'll eat into the operating margin of these companies, which averages about, 8 or 9%. However, given their existing cost-cutting efforts, a pay raise, I think, is affordable. And as I was saying earlier, given what's happened with inflation since the last contract was agreed, it's justified. I also don't think it's helpful for the likes of GM that the pay of their top executives went up quite a lot as profits jumped in the last couple of years. I mean, for example, Mary Barra at GM, her pay last year was 362 times the median pay of a worker at that company. So it's going to be hard for the car company to cry uncle on this completely.
That's right. Barra we were just talking about this. She got paid $5 million in 2012. Now she gets more than $28 million. Jim Farley got $5 million in 2012. Now he gets more than $20 million. Yep. Carlos Tavares is getting $25 million. So these CEOs are getting paid not only a lot more than the worker on the floor, which I guess makes sense, but their pay has gone up, in some cases 5 to 6 times what it was in 2012, while the workers are getting paid pretty much the same.
Yeah, and I think, it was interesting for me when Ford proposal, which obviously the UAW dismissed, as is the usual way with these things. What I thought was interesting about it was less the numbers, but more the structuring of it. And effectively what Ford was trying to do was to say, okay, we'll up pay, we'll give upfront bonuses. The idea being to effectively kind of compensate UAW workers for the hit they had taken to real incomes over the past couple of years. But what they wouldn't agree to were things like restoring defined benefit pensions, raising wages structurally rather than through one-off bonuses. And I think the idea is they're trying to, meet the UAW in terms of what's happened to its standard of living over the last couple of years.
Right.
But it doesn't want to embed structural costs that will then eat into margins, over the longer term.
Yep, absolutely. All right, Liam, thanks so much for joining us. Liam Denning, he's a columnist for Bloomberg Opinion. He's got a column out today, or in the last day or so. Striking auto workers can't bring back the 1950s, basically saying this is an industry that has changed. It's going to continue to evolve. So it'll be interesting because both sides, Matt, as I read more and more about this, both sides have some very, very good points to make. But I would argue that means that there's room for negotiation and compromise.
Absolutely. Great point. Some seem like an overreach. Defined benefits, pension, and a 4-day work week.
Yeah.
I like that.
I like that as well. Maybe I'll pitch that someday. This is Bloomberg. All right, let's get some company news right now with Mr. Steve Rappaport.
Paul, Instacart has raised the price range for its initial public offering. Bloomberg's Charlie Pellet has more.
Steve, Instacart is the largest grocery delivery business in the United States, and the move follows a strong trading debut for chip designer ARM Holdings. According to a filing, the company and existing shareholders are now seeking to raise as much as $660 million. They're marketing 22 million shares at $28 to $30 apiece, up from a previously indicated range of $26 to $28 each. The decision comes a day after ARM soared in its trading debut. Steve?
Thanks, Charlie. Striking Hollywood writers have agreed to resume negotiations with TV and movie producers. The latest on that from Bloomberg's Ed Baxter.
The AMPTP, representing the studio, streaming services, and production, say the Guild reached out asking for a meeting and that they had agreed. The strike has gone on for 4.5 months over issues including pay, job security, and the big issue, the use of artificial intelligence. Previous attempts to restart talks fell flat. A handful of meetings last month, but nothing. The writers said they got a lecture on how good the studio's offer was. So no date set yet, but a glimmer of hope for next week. In California, I'm Ed Baxter, Bloomberg Radio.
Thanks, Ed. The European Union has hit TikTok with a $368 million fine for failing to protect children's privacy data under the EU's strict data privacy rules. Chinese-owned TikTok says it disagrees with the decision, particularly the level of the fine imposed. Those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Stocks open lower. You have 9 of the 11 major industry groups in the S&P 500. They're down right now. Biggest drags, they're coming from consumer discretionary as well as information technology. Triple witching day, so you can expect some degree of volatility. Meantime, Barry Knapp, managing partner at Macro Risk Advisors, making a bullish case for stocks
Listen, I think the S&P is going to 4,800 by the end of the year. I think that we're going to have some weakening of the growth outlook, but the Fed ending and starting to really price in cuts next year. So there's room for further rally through the end of the year.
Important data at the top of the hour. U.S. inflation expectations as measured by the University of Michigan falling in early September to the lowest levels in more than 2 years. And finally, as we just heard from Mary Barra right here, General Motors shares today, they are up 2%. S&P 500, the Automobile Manufacturers Index, that is one of the best performing groups since the start of the year, up 96%. Right now, the S&P 500, 24 points lower. That's down 0.5%. We're at 4480 on the index. The Dow Jones Industrial Average is 80 points lower. The NASDAQ 100, 152 points lower. That is down 1%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash.
John Tucker. John Tucker, thank you so much. We appreciate it. Matt Miller, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube.com. So just head over there and search Bloomberg Radio. So, Matt, I've been to a few Disney's, a few theme parks in my day, but the way I go as part of a Disney Investor Day where they shut down the park and allow the analysts and investors to go wherever they want and ride as many rides as they want. That's how you do it.
So you get to no lines, and you're on Space Mountain like over and
over again, and that's how you do it. I can't imagine going with.
That's like a dream come true.
Space Mountain, that's like kind of lame.
What? Space Mountain rules.
Dude.
I mean, look, you're talking to a guy.
When was the last time you were there?
From the
72?
great state of Ohio. So I've ridden the Beast, I've ridden the Gemini, I've ridden the Demon Drop, Kings Island, Cedar Point. I'm all about it. But I loved Space Mountain.
All right, and our Geetha Ranganathan, she covers all the media stocks, which means she covers Disney, which means she's going down to their Investor Day, so she'll be all over the place, I'm sure. Hey, Geetha, there's going to be a lot to talk about at Disney here. Are they really going to sell the ABC television network?
Definitely seems like it, Paul. I mean, Bob Iger just a few weeks ago, of course, at that Sun Valley conference said that, they're not married to the linear TV network business. It's not core to Disney anymore. I mean, that's so ironic considering, they bought ABC for that. It was that huge deal back in 1995 for $19 billion. I mean, so much of, Disney's reputation has, kind of been tied to its TV network. So it's strange, but I think what it really tells us is that they see the writing on the wall and they think that the pay TV universe is probably going to implode sooner than the rest of us think.
All right, so who could buy it and what's it worth?
Okay, so there are a lot of rumors and a lot of press reports right now circulating. So there has been some talk about Disney exploring a sale of ABC networks and the owned and operated stations. They have about 8 stations in top 10 markets with Nexstar, which is the largest TV broadcaster right now in the U.S. So, Nexstar has said that they're very interested in the ABC assets. They should be able to acquire most of them without too much friction, meaning there is an FCC ownership cap of about 39% for broadcast stations. But Nexstar, because it already has a presence in most of these stations with their CW network, thinks that it should be able to get the deal done. That said, I mean, I think they still will have to,
and they have the money.
Swap some. So that is a little bit of a question mark. Yep. So we think that the ABC stations are actually worth upwards of stations as well as the network are worth upwards of $4 billion. That's applying a pretty conservative 7x EBITDA multiple. Now, Byron Allen, who is like this really prolific media mogul, has put in a bid which apparently values those networks at about 8x EBITDA, which means that the ABC property would be worth $5 billion. And obviously Disney wants to get the most for it. The problem with most of these acquirers or the parties that are interested in possibly acquiring ABC is that they're all highly levered themselves. So most broadcasters, so even an Nexstar, for instance, currently has about $7 billion in debt. Allen Media obviously has a lot in debt. So we'll have to see how they kind of get the deal done.
So, Geetha, I guess that calls into question. It's one thing to sell a declining broadcast network and some TV stations. I think most people would agree that, all right, the time of that business is probably past, and it's all about streaming. The bigger question, I think, for a lot of investors, and you'll probably talk about it next week when you're down visiting the Walt Disney folks, is ESPN. What do they do with ESPN? What do you think is what do you think they will do? What should they do?
So ESPN, I actually think they definitely want to keep the asset. Now, remember, they are going to be breaking out the financials for ESPN in a few quarters. That is what they've promised. It's going to, kind of be its own segment. And that's the first time that they're doing that in Disney's history. So they obviously want to clean up house before they do that. And we've seen a lot of, cost cutting. We've seen a lot of these new deals. They had that deal with, Penn National. And most recently, and I think this is really transformative for the entire pay TV universe, is the deal that they inked with Charter. This is the first time in the history of the pay TV media ecosystem that a content company is actually offering access to its streaming services, okay, and for kind of either a wholesale rate or even for free in certain cases. But the more important part is that they're actually going to offer access to the flagship ESPN streaming product when it goes out in full force, which probably will be sometime in 2025, 2026. We don't know. But they're definitely preparing for that future. That's what it looks like. So I don't really think that they want to kind of get rid of this asset. Maybe they really want to clean it up. Maybe they want to spin it out. But I still think they want to keep control of it.
I wonder if this is like, Paul, the kind of shift that you saw when radio used to be it. Radio used to be the thing for listeners and for advertisers, and that all went away, and it's probably a completely uninteresting business for most people. They went to TV, right? Is this linear TV going through that same transition, that same death? And then is streaming the new TV?
Yeah, I mean it was, we went from broadcast television when you had 3 networks and then 4 with Fox, and then cable TV came along, and that totally redefined what we watch, how we watch it, and it really made it so much more competitive. We got so much more product. Now you're even taking that to the next stage. And I guess, Geetha, that brings us to the question, if all the big media companies that you follow, the Paramounts of the world, the Warner Brothers, the Discoveries, when you talk to investors, do they believe that this transformation can actually work and they can make money on it, or does nobody want to talk to you anymore?
A little bit of both. But I think the one thing, for any investor who had questions about whether streaming is a good business, I think we have our answer, right? Because we've seen Netflix kind of turn things around. They are actually expected to generate about $7 billion in EBITDA this year, approximately 20% margins. And the idea is that as they kind of gain subscribers and as they lower costs, they're able to kind of spread those costs over a wider base, eventually getting to, a 25 to 30% margin, which then kind of makes you agnostic because in its heyday, TV networks were generating about 35% margins. So yes, streaming may not be better than the TV network business, but it could potentially be as good as. Again, that we're talking about Netflix, which is obviously the industry leader. It is going to be a much harder road for all these smaller companies, whether it's a Paramount or Warner Brothers Discovery. But they are kind of doing a lot in terms of content cost rationalization. Again, Paul, we've spoken about this many times, and I know you think too that there will be a streaming shakeout at some point. There will be consolidation. So all that is going to play out, I think, over the next 18 months, 18 to 24 months. But yeah, I think we will be, we'll land up with maybe 3-4 major streaming players who should be all profitable, hopefully.
All right, now we've got some, in addition to all of that, if that wasn't enough for the industry and for investors, there's also this thing of strikes. We've got writers on strikes, we've got actors on strikes. What's the impact on media, on the companies, on what you and I and other consumers will be able to see on our TV screens and in theaters?
Yeah, so definitely we're seeing some, small effects of that right now. Nothing really major in terms of disruption of schedules, but, as we kind of get deeper into like the film slate for 2023 and even 2024, that's when we're really going to start having some problems. We've already seen some film delays. Dune 2, for instance, from Warner Brothers has already moved to 2024 because they're not able to market the film. They're not able to do promotions. So that's, a lot of film studios are kind of running into that problem. In fact, from a financial aspect, though, what we're seeing is that most of these companies have actually raised their free cash flow guidance through the rest of the year. They've raised their free cash flow guidance, but they've lowered their EBITDA guidance because the lack of fresh programming is definitely going to have an impact on, advertising sales. And that's what they've all said. They've all said, expect double-digit ad declines because you're not going to have any fresh programming. We really have nothing to go to advertisers with. I think it really becomes a problem in 2024 if they're not able to resolve the strikes, if people are not going to get back, to work and produce new content. We're going to have a real headache in 2024.
All right, Geetha, thanks so much for joining us. As always, Geetha's the expert. Geetha Ranganathan, she covers all the media industry.
And she's going to the park.
And she's going down to Disney.
On Monday for the investor. I was thinking, because Tucker asked when the last time I was there was, and I remember that the Corey Hart album, Boy in a Box, had just come out. I bought the cassette for my Walkman, and so I believe it was spring break of 1986.
Spring break? That was your high school spring break?
I was 12.
The rock and roll roller coaster at one of the theme parks at Disney, I think that's absolutely fantastic.
I don't think that was there yet.
I don't know. All right. With our news in New York City, here's Michael Barr.
Thank you very much, Paul and Matt. President Joe Biden will deliver remarks later today on the United Auto Workers strike against all Big Three Detroit car makers. The UAW began the unprecedented strike at midnight, kicking off a potentially costly and protracted showdown over wages and job security. Workers walked out of a Ford plant in Michigan that makes Broncos, a General Motors factory in Missouri that assembles Chevrolet Colorado pickups, and a Stellantis plant in Ohio that builds Jeep Wrangler SUVs. The union and automakers are still far apart after weeks of talks. UAW President Shawn Fain says employees are only asking for what they deserve, cost of living adjustments.
The price of vehicles went up 30% in the last 4 years. CEO pays went through the roof. They're already millionaires. They went up 40%. Our workers got 6% pay increases, and inflation went up 19%. We're going backwards.
Meanwhile, GM CEO Mary Barra says the company is bargaining in good faith.
I'm extremely disappointed and frustrated that we're even on a strike. We didn't need to get here. General Motors has an exceptionally strong offer on the table. It's historic. It's the largest increase from a wages perspective in our 115-year history.
Barr spoke with Bloomberg's David Weston this morning on Balance of Power. Hunter Biden's lawyer says the new gun charges won't hold up in court. If convicted, President Biden's son could face up to 25 years in prison after Special Counsel David Weiss indicted him on 3 felony charges. Just months after he was convicted of murdering his wife and son, Alex Murdaugh was back in court again as the South Carolina attorney faces over 100 new charges of various financial frauds. Global news 24 hours a day, powered by more than 2,700 journalists and analysts.